meeting is being recorded.
Start your session, sir. I started the recording.
Yes, sir. Yes,
Sir,
sir. Yes, sir.
anybody having issue in audio? I don't think. Mr. Ganapati, please check your mobile, whether you turned off by mistake. So no one is having audio issue. Kindly check your side. You will be able to get it. Thank you, sir. Thank you for the feedback, sir.
Yes.
We can start, sir, quickly.
Yes, sir. Yes, sir. Yeah. Good morning, friends, and welcome to this CBOA promotion classes. I am very much thankful to Mr. Ravi, GS, and other team members, and also thank to Anand Krishna sir for taking very much pains regarding these classes. And of course, as a previous CBOA member, it is my duty to extend help to all my colleagues. That's what. So today we will start this credit policy. Credit policy. First, I will tell you small introduction why this credit policy is this much important. So just to briefly, so that you will understand what is this credit policy and also what is the importance for this credit policy bank is giving this much. Okay. So as a banker, our main duty is to accept deposits and convert them as assets. That means we are accepting deposits and giving loans. That is loans, nothing but assets. Deposits are liabilities. This is what in our balance sheet, simply. So if you see our balance sheet, here you can see, for example, we will take 100 crores, we have accepted deposits. This 100 crores, we have to convert. This is liability for us. Whatever we are accepting deposits in our balance sheet, it is liability. So this liability we have to convert as asset. That means we have to give this deposit as loans and advances to customers, so that we will get interest, right? Because our duty is to accept deposits and lend it. There we will earn income. That is what profit. So out of 100 crores deposit you are accepting, you cannot give away our entire amount as loan. First of all, we have to maintain CRR 3.75% at present. Of course, from next month onwards, it will be again 3.5% and next 3.25, and it will go to 3% starkly. So as per section 42 of RBI Act, we have to maintain certain percentage of our deposits in the form of cash. So now 3.75% is the cash we will keep as it is. Earlier, Reserve Bank used to pay 3% interest. Almost about 20 years ago, Reserve Bank has stopped giving interest on this CRR balances. That means after 1 year, whatever the CRR 3.75 crores we are keeping out of 100 crores deposit as a CRR, you will not get any return. So after 1 year, your 3.75 crores will be as it is 3.75 crores, right? Next, second one is SLR, statutory liquidity ratio. Again, as per section 24 of Banking Regulation Act, we have to maintain 18% of our deposits in the form of government securities, etc., etc. That is called as SLR, that is statutory liquidity ratio. So SLR is 18% at present. What is the return we are getting on this SLR? Approximately 5.5% we have taken, because we will be investing in the form of bonds, securities, government securities.
Sir, excuse me.
Yes, sir, please.
Sorry to interrupt. Can you maximize this screen, sir, so that if it's not inconvenient to you.
Yeah, I will also maximize the. And apart from that, sir, actually, 1 minute I am using earphones. 1 minute I will remove so that I am getting some hissing voice out of this.
Okay.
2 minutes I will.
Because many people are watching through mobile, So if you show on full screen, they will be able to see the letters properly.
Speaker has changed to speakers. Yes, sir. Sir, now am I audible clearly?
Yeah,
sir?
very clear, sir.
Because earlier with earphones, some uncomfortable I was having. Yeah, now we will continue. Yes.
Because people are watching through mobile, sir. So
Yeah. It will be.
letters
Yes,
will
sir.
be visible to them.
Yeah, now it is sure, sir. Let me do that.
So now your mic is audio is
Yeah.
bit
More
volume is less than
less,
earlier.
Now is it because earlier I was using that earphones. Now
Maybe
is
that
it okay, sir?
that mic was better.
That earlier mic? Shall I use earlier mic or shall I continue with this, sir?
You use that microphone, sir. It's so.
Microphone. Okay, sir. Okay.
I kindly request all the participants to mute their video. It is not required. I am disabling one by one, but
Yes, sir.
yes, sir. Please, sir. You can go out, sir.
No, I will continue, sir.
Yeah,
So,
it's clear, sir. Audio.
yeah, 18% of what we have taken as deposits, that is 100 crores, that is 18 crores. 18 crores we will keep as SLR, statutory liquidity ratio, in the form of government bonds and other securities. So what is the return we are getting on that? Approximately 5.5%. Okay. And the remaining amount, what is that? 78.25 crores. Out of 100 crores deposit, we have taken out CRR and also we have taken out SLR. Now, remaining amount 78.25 crores we can give as loans and advances. Suppose you are unable to give the 78 crores as loans and advances. Ideally, we cannot keep that amount because we have taken deposit and this for depositors we are paying approximately 5% interest. We have taken approximately, right? Here, that amount you cannot keep here as ideal. So what you have to do this amount? Already we have given some portion as loans and advances. If you are unable to give full amount, that is 78.25 crores as loans and advances, in such cases, we have to go for investments. That means we will invest in government securities or different types of securities.
You are in class.
There also we will get return, but a little less than what we are getting on advances, loans and advances. So here we have taken average 7% return approximately for this 78.25 crores. So it comes to 83.73 crores. So SLR as it is 3.75, the CRR as it is 3.75, SLR it is 18.99 with interest, 5.5% interest we have calculated. And loans and advances approximately with a 7% return, we have taken as 83.73. So total here, how much we got after 1 year? 106.47 crores. And how much we have to pay? 105 crores we have to pay to our depositors. And another one small question for you. Are you able to recover entire your loans and advances without NPA, without write-off, without compromise? It is highly impossible because every business is having risk and bank business also having risk. So we cannot get entire 83.73 amount as it is here. Our loans and advances with interest, 100% we cannot recover. Some NPAs, some write-up will be there, some loss. For example, if you incur 2 crores loss in this portfolio, you will receive only 104.47 crores, whereas you have to pay to depositors 105 crores. That means here you are incurring a little loss. So Reserve Bank, what it says as a regulator, it is protecting the interest of your depositors. So Reserve Bank says if you are incurring any loss in this portfolio, your loans portfolio, don't pass on this loss to your depositors. You cannot go to depositors and ask, Are Baba, we incurred some loss in our loans. You also reduce some interest on your deposits. We cannot ask. If you ask what happens, it leads to systemic risk. The entire banking system will fail. That is what we call a systemic risk. So Reserve Bank, what it is telling, don't pass on your loss to your depositors. Instead, you absorb that loss. How you will absorb that loss? For that, you have to maintain certain percentage as capital. This is what Basel Accord has come into existence. Now Basel 3 is running in a 11.5% we have to maintain capital in relation to your risk weighted assets. That 11.5 is including your CCR, capital conservation. So here, what Reserve Bank is telling, you absorb that loss out of your capital for which you have to maintain certain capital. This is what Capital Basel Accord has come in. So what is our business? To earn profits, we have started business. Now we are telling approximately 2 crores loss if you incur, it will be reduced from our capital certain portion. So what is our duty now to earn profits? You should increase your profits so that we have to here minimize the losses. How we can minimize the losses? While giving loans and advances, we have to follow certain guidelines. So if you follow those guidelines, your losses will be reduced. So here, instead of getting 4.47, if you receive 106 as it is, and you will get 1 crore profit. So you have to reduce expected losses in your loans portfolio. For that, what you are supposed to do, that is all given in our credit risk management policy. This is what given our CRM policy. And again here, how we will calculate these losses and what are all it is given in our CRM policy to minimize these losses. This is covered in our credit policy and CRM policy. This is briefly introduction for our CRM policy. Now we are going for this. What is this credit policy and subsequently CRM policy also we will go, right? Now, this policy as it is, policies and strategies we call, and while giving loans, it is divided into two areas. One is our target markets are divided into two areas. One is called as trust areas, and second one is non-trust areas. Trust areas and non-trust areas. Trust areas means where we can lend without restrictions, much restrictions. Normal restrictions will be there for us, guidelines. Where we can lend without much restrictions, it is called as trust areas, where we have to give priority for our loans. These trust areas include agriculture, industry sector, MSME, all priority sector it will come. Apart from priority sector, again, infrastructure, industries, big industries, everything will come here. This is trust area. And then what is non-trust area? Non-trust area includes mainly four aspects. One is commercial real estate. Second one is non-banking finance companies. And third one is capital markets. And the next one, fourth one, industries which do not have any growth potential. Right? Regarding trust areas, actually priority sector classification, etc. is given in this policy. Anyway, priority sector will be dealt separately. That is why we are not touching that priority sector. Straight away, we are going for other aspects of our credit policy. So first one in this, only for exam purpose only, we have taken all important points. So that is why let us discuss first about startup, definition of startup. Startup definition up to a period of 10 years from the date of incorporation. That is from the date of birth of a firm. If it is a company, it is date of incorporation. If it is a partnership, it is date of registration. So from the date of birth of a company up to 10 years. And during these 10 years, turnover of that entity is not exceeding 100 crores. Then we call it as startup. That means 10 years from the date of birth, and during this 10 years, turnover is not exceeding 100 crores. So for that, we call it as startup entity. Right? Now, yes. While giving loans, first we have to go for credit information. Credit information. So credit information, for drawing credit information, we have tied up with 4 companies, that is TransUnion Civil, Experian, Credit Information, Equifax, Trip Highmark. These 4 are credit information companies. We have already entered into tie-up with these companies for drawing credit information reports. Right? This credit information report, it is a 3-digit score again. If they score 750 and above, again low risk 749, 700 to 749, it is normal risk CS2. Like okay, figures you can go through because only wherever some explanation is important that I will explain. And wherever you want, you have to draw single CAR reports. That is certain cut-off limit it is given. Say, for example, housing loans up to 10 lakhs, only one CAC is required. Beyond 10 lakhs, 2 CACs. Like that, this is also figures. We will go further. Because already I have shared the material already. It contains all whatever these PowerPoints are there. That material is available in the material already shared. These PowerPoints also I will share to Ananta sir, and you may get this also, right? So this is all again for gold loans. Only one CAR is required. And next one, suppose if you are giving loan for a business entity, there you have to draw CAR under commercial segment. Okay. Apart from commercial segment, you have to draw CAC under consumer segment also, because to know their repayment history. In that consumer segment, if they get less than 650 marks in this CAC report, their sanctioning authority, it up to RO head CSC, it is next higher authority, and above RO head CSC, concerned respective sanctioning authority will sanction. Right? Again, for retail loans, it is Canada retail grade rating we have to do. Again, here also basing on scores, retail grade is given, and sometimes in exam they are asking in CRG a person got 85 marks. Which rating grade is that? It is CRG1 low risk 2. Like that, only basing on marks, rating grade is given and description also given. This is only description, we will go further. And last year again regarding retail grade, they have given 2 points. One is near prime and subprime. And what is this near prime? To avoid concentration risk, particularly in respect of low rated. Low rated means their rating is not good. Borrower's rating is not good. We should not give more loans to such borrowers because it is high risk, and again we have to maintain more capital, etc., etc. That is why for near prime and subprime categories, there is a restriction imposed by bank. What is that restriction? For near prime borrowers, who are near prime borrowers again? CRG3 borrowers, where they are getting grading rating as CRG3. In case of CSC score, 730, 681. CRG3 near prime borrowers, maximum 10% of total retail loans, whatever you are sanctioning during that year, out of total retail loans sanctioned during that particular year, only 10% of loans we will give to near prime borrowers. That means CRG3 category borrowers. And again, triggering point. What is the triggering point? If it is reached at 9%, we have to stop further lending at branch level because we should not cross 10%. If you are going lending at branch level, we cannot control. That is why when 9% overall it is reached, we call it as a triggering point. Beyond that, branches cannot sanction loans to these near prime borrowers. And similarly, subprime borrowers. So for subprime borrowers, maximum we can lend only 5% of retail loans in a year. How many loans you are sanctioning in particular year for retail loans? Out of that, only 5% only we will sanction. Right? And again, here also triggering point where branches should not lend. That is 4.5%. Out of total retail loans, if subprime people, it reaches 4.5%, then branches cannot sanction. This is what we call triggering point. So last year exam also they asked this question, near prime and subprime, because it is introduced last year only. And now we are going for non-thrust areas. Non-thrust areas, First one is commercial real estate. Commercial real estate. And regarding real estate, the main definition of real estate is real estate loans. They are given, real estate loans are given for creation of additional space on vacant land or on existing construction. Creation of additional space on vacant land on or on existing construction. This is what we call as real estate loans. We are giving loans for construction purpose. We are creating additional space. This is real estate loan. And this real estate loan, it is again classified into two types. One is commercial, second one is non-commercial. What is non-commercial loan? All housing loans, they comes under non-commercial. And apart from housing loans, if you are giving loans for business people for construction of their own office, like shop or doctors for hospital, like that, in such cases, they are also non-commercial real estate. And then what is commercial real estate? For commercial real estate means real estate means you are giving for creation of additional space. Same thing here. You are giving loans for creation of additional space only, but here the repayment for this loan is coming, primary source of cash flow for towards repayment is coming out of either lease rentals or sale of the asset. Here. Okay. Main here for definition of commercial real estate, the main point is repayment. More than 50% of cash flows towards repayment, it comes from either rental receipts or sale of the asset. For example, I will tell you, you are giving loan for construction of one shopping complex. How repayment will come for this shopping complex? Either the real estate person may sell the shops and repay to us, or if it is for rental purpose, the person may give it on rental basis and out of rental receipts, he will pay to us. So here repayment is linked to either lease rentals or sale of the assets. Here we call it as commercial real estate. And about 2-3 years ago, there was a question in exam. Bank has given loan for construction of a office premises to a chartered accountant. And where you will classify this? Chartered accountant, you have given loan. Whether you classify as commercial real estate or non-commercial. Non-commercial means housing and own business premises. Commercial means it is for sale or for leasing if they are constructing. So here it is not for giving, it is not for sale, or it is not for rental. It is for own business purpose. Hence, it is non-commercial real estate. So this is the definition. And what are the restrictions for this commercial real estate loans here? Yeah. In between, there is one more head, commercial real estate residential housing. What is this commercial real estate residential housing? Loans given for construction of housing projects, residential housing projects, wherein the commercial space in that project does not exceed 10% of total construction area. Suppose you are giving loan for apartment construction. In that apartment construction, out of total construction area, not more than 10% they have given for commercial. That means they may give for shopping, some shops or schools, etc. They are not residential. So in such case, we can classify it as commercial real estate residential housing. So definition has come in exam earlier. Loan given for builders for residential housing projects wherein commercial space that does not exceed 10% of total floor area index. That means total built up area. And normally in case of commercial real estate, we are not supposed to lend for purchase of land. If party has already purchased land, we will consider it as margin. So there is no question of giving loans for purchase of open site. For individuals also, we can give, that is Canada site is there, we will give loan for construct or purchase of site. But here we take undertaking letter from the customer stating that I will start construction of house within 18 months. Then only we will give loan for site, open site. Otherwise, normally for purchase of land to real estate people, we cannot lend, but we will consider it as a margin, right? And one more government guidelines regarding this commercial real estate is in their brochures, that is pamphlets, they have to give full details like to which bank this project is mortgaged. And whenever purchasers require, we will give them NOC from that bank. Like that, they have to print in their brochures. This is government guideline regarding commercial real estate. And the next one, another one, if you are giving housing loans to individuals up to two housing loans, up to two houses, we can consider as housing loan. If you are giving loan to for construction of third house, normally how repayment will come? Third house means they cannot occupy one house, okay, or two houses also they can own occupation, we can treat. But third house we cannot treat as own occupation, and compulsorily it will be given as rent. So here repayment more than 50% of repayment will be rental receipts. That is why if you are giving loan to individuals for third house units, then it is commercial real estate. That is why for a third unit onwards, we will charge more 0.25 or 0.5% like that, more interest we will charge. Right? Next, for commercial real estate project parameters, this is also recalled questions. For single project, loan should not exceed 500 crores. For single project, commercial real estate project, loan should not exceed 500 crores or 3.33 times of tangible net worth of the borrower. Total tangible net worth for the 3.33 times maximum only we will give. And debt equity ratio not more than 3:1. That is second one. And promoters contribution here, minimum 50%. Promoters contribution. Out of that, again, 25% should be equity or quasi-equity. Normally, for any project loans, whatever margin we are prescribing, out of that, at least half should be their own equity. So here also the guideline, minimum margin is 50%. Out of 50%, at least 25% should be their own money, equity and quasi-equity. And out of that again, equity means their own money. Quasi-equity means outside borrowings subordinated. Repayable in more than 12 years, normally we consider under quasi-equity. So here their minimum equity should be 17% out of that again. So total margin is 50%. Out of 50% margin, 25% their own money should be there. Out of that again, own equity should be 25% and 17% and quasi-equity maximum 80% only. And the remaining 25% margin, it may be advance money because they are constructing shopping complex. They may take advance from shop owners who want to buy that shop, right? And the next one, if land is not purchased, then total margin out of total margin 50%, 34% is minimum equity and 16% is quasi-equity. Quasi-equity again, I told you, subordinated debts, outside borrowings, long-term borrowings, subordinated debt and more than repayable in more than 12 years. Suppose if land is to be purchased from government, then margin can be reduced to 40%. And out of that again, 28% is equity capital and 12% maximum is quasi-equity. Debt service coverage ratio 1.50. Any term loan, you have to keep in mind, debt service coverage ratio, generally it is 1.50. And the higher authorities, again, wherever it is required, they may reduce it to less than that. Here, it can be reduced to 1.25 in exceptional cases by sanctioning authority. Fixed assets coverage ratio 2:1. For this commercial real estate, it is 2:1. It can be reduced to 1.75. Whereas other term loans, project loans, normally FACR 1.3 to 1.2 we will accept. 1.33 or up to 1.2 we will accept normally. But here it is FACR 2:1 higher because it is non-trust area. Restrictions are there. We cannot lend liberally. Right? Next, repayment period 3 years if it is sale of property. That means if it is a shopping complex, they have to sell and repay to us. In such cases, repayment is 3 years. And 7 years in case of lease. Suppose shopping complex they have constructed and given on rental basis. Out of rental, repayment will come. So there up to 7 years we will give repayment. Overall, maximum 10 years it should not exceed, including moratorium. Right? Next, another about 3-4 years ago, another one important aspect bank has given, while sanctioning commercial real estate loan, compulsorily you have to obtain collateral security. Primary security, normally whatever construction they are doing shopping complex, that will be there as primary security. Apart from primary security, you have to obtain collateral security also. What is the extent of this collateral security? At least equal to loan amount. That is 100% collateral security is required. And that collateral security is distress sale value. It should not be less than total loan amount. That is what I am telling. 100% collateral security. But it can be reduced to 75% at HO level. GM 75% up to 75 to 50% also it can be reduced by EDCAC like that. Leverage is also there. But general guideline, while sanctioning commercial real estate loans, they have to give collateral security equal to, at least equal to our loan amount. Just a sale value of collateral security would be equal to loan amount. Right? Next, project appraisal. All projects are subjected to project appraisal. What is this project appraisal again? While sanctioning term loans, project loans, whatever proposal they are getting, that is their proposal they will bring. This is what our project report. That project report, whatever they are bringing, we will send it for project appraisal. Project appraisal normally it will be done by project appraisal cells at circle office or project appraisal group at head office. Basing on sanctioning authority, it will be at, of course, at circle level up to 100 crores only they will do if it is headed by GM, and up to 50 crores only at circle level they will do if it is headed by DGM. Beyond that, it will go to PAG at head office, project appraisal group at head office. So for this cutoff limit, normally what is this cutoff limit for new borrowers 10 crores and above? They have to get this project appraisal done by PSC or PAG for new borrowers. And for existing borrowers, again, basing on risk rating and their dealings, it is separate. Suppose party is dealing with us for more than 3 years and above and rated as low risk or normal risk. In such cases, 20 crores is cutoff point. If borrower is dealing with us less than 3 years, in such cases, low risk and normal risk party, 15 crores is cutoff point. And for moderate risk, 10 crores is cutoff point. So project appraisal, 10 crores in case of new parties and moderate risk rated parties, and 15 or 20 crores in case of low risk and normal risk parties. But here it is not 15 crores or 10 crores. All projects of CRE, commercial real estate, should be appraised. Only for CRE RH up to 5 crores it is exempted. And the next one, LTV, loan to value. It is a monitoring tool. What is this loan to value? Equation is liability divided by security. Liability means total, our principal, interest, charges, etc. Whatever outstanding liability is there, divided by value of security. This is called loan to value ratio. For all these real estate loans, LTV is very important. Even for gold loans also, now LTV Reserve Bank has given. It should not exceed LTV ratio this much like that. Okay. So here, LTV, how we will monitor? As it is, I told you, 50% is margin. That means your loan is 50 crores. In such cases, security should be 100 crores. Because only 50% is margin. For 100 crores project, you will do only 50 crores. So 50 crores is loan, 100 crores is your security. There, LTV is 50%. So after 1 year, your loan has become 55 crores, whereas security only 100 crores. There, LTV is 55%. That means it is more than what you have accepted in the beginning. LTV ratio, it is growing means either principal is not repaid or value of security is coming down. It is the adverse feature. If LTV ratio is coming down from accepted level, then it is good. This is what monitoring tool, loan to value ratio for real estate loans. It is very, it is good monitoring. So here, whatever you have accepted at the same time of sanction, this LTV ratio, it should not grow more than what you have accepted. Next, regarding valuation, it is to be done in once in 3 years. Normally for all real estate, not only real estate, even fixed assets, normally once in 3 years we will do valuation. Here also same condition. But if account appears in SMA 1 or shows any early warning signals, in such a case, immediately valuation is to be done once in a year. Normally once in 3 years, but any adverse features are there, yearly we have to do. And no separate working capitals for commercial real estate. You should not give running account OD OCC for commercial real estate. And if they require working capital limits, it should be sublimit of your term loan. Whatever term loan we are sanctioning, project loan we are giving, maximum 500 crores we can give to a party. Out of that maximum loan, you fix a sublimit towards working capital, but not separately. No question of running account, permanent running account. Okay. Next, here two guidelines. One is National Building Code Guideline, NBC 2005 guidelines. It is applicable for construction these loans where building cost of this project exceeding 25 crores. What is this National Building Code? They will give so many guidelines like that. What is that? In case of any fire accident, fire engine should run round the building. Something like that. Guidelines are there. It is called as National Building Code Guidelines. They are applicable for our for this construction of building exceeding 25 crores. And second one is National Disaster Management Authority guidelines, NDMA guidelines. And what is this NDMA guidelines again? Here also they will give how they have to construct, how much space they have to leave, like that. It is guidelines are given. And these NDMA guidelines are applicable for real estate exposure loans 1 crore and above. 1 crore and above, including housing loans, it is applicable. So two guidelines, NBC and NDMC guidelines. NBC 25 crores, NDMA 1 crore and above. Next, capital market exposure, second one. What is this capital market? Again, share market, because this is second one, non-trust area, where you should not lend liberally. Second, restrictions. You have to lend with certain restrictions. Second one, capital market, that is share markets. Normally, maximum loan to capital market should not exceed 40% of bank's net worth as on 31st March of previous, either as solo basis or consolidated basis. That means basing on our balance sheet. If it is a solo balance sheet, then it should not exceed 40%. If it is a consolidated balance sheet, there also it should not exceed 40% of bank's net worth. And out of that again, direct investment in shares, bonds, venture capital, etc., it should not exceed 20% of our net worth. So maximum loans to capital market is 40% of our net worth. Out of that, direct investment by in shares, it should not exceed 20% of our net worth. Next, again, credit facility extended to share and stock broking activities only. If you are giving loans to share and stock brokers, it is for broking activity, not for buying shares and keeping idle with them. It is called speculative purpose. So not for speculative purpose. It is only for share and stock broking activities you have to give. Here normally, if you are giving loan to stock brokers, margin is 50% for OD facility and CDB, 20% in case of intraday. And against loan property, we can give loan to share brokers. Their margin is 40%. And for other businesses, normally no loans against primary security of shares and debentures. We can give loans against shares to individuals only. We cannot give loans against shares, primary security of shares to either partnership or company, etc. We cannot give. But you can accept as collateral security. Suppose some partnership firm, they are offering shares, then we can accept as collateral security, not primary security, right? Next, Margin on advances. Normally against shares, what is the margin we will prescribe? 50%. Suppose if shares are in demat form, 25% margin we will prescribe. And in case of bank guarantees for capital market operations, there also margin is 50%. Out of 50% margin, again, at least 25% margin, it should be in the form of cash. Cash means either cash deposits. Remaining 50%, they may give in other form. Right? Next, advances against units of mutual funds. While sanctioning loans against mutual funds, what value we will consider? Either net asset value or repurchase price or market value, whichever is less, we will consider as security. And for mutual funds also, we will give loan, but within 20% of the net asset of the scheme. The two for a period not exceeding 6 months. Suppose some mutual funds people, they come and approach. There we will give up to 20% of net asset of that particular scheme. Okay. Now, third non-trust area, lending to non-banking finance companies, NBFCs, normally statutorily registered with RBI, then only we will finance. Here, definition for NBFC is, first of all, principal business of NBFC. What is this principal business? Actually, for class, different types of NBFCs are there. What is their principal business? We have to ascertain. Is it a factoring company, or is it asset financing company, or is it a loan company, or it is a core investment company? Like the different categories are there, basing on their principal business. And for definition of principal business is that 50% of its loans are given for physical assets creation, and 50% of that NBFC income is coming from that activity only. Wherever they have given loans for physical assets creation, out of that 50% total, out of total income, at least 50% is coming from that activity. It is general for all NBFCs, it is minimum 50%. In some cases, it may exceed 60. Suppose next one I will tell you, asset finance companies. What is the definition of asset finance companies? Financing for physical assets. And this physical asset finance, at least 60% of this NBFC loans are given for creation of physical assets. Then we call it as asset finance company. So at least 60% of this NBFC loans are given for creation of physical assets. And 60% of their income is also coming from that physical asset financing. Then we call it as asset finance companies. Minimum criteria is 50. Here, 60% for this. So infrastructure finance companies, here 75% criteria, not 50 or 60. 50 is minimum. So here, if they deploy any NBFC, if they deploy their loans, 75% of their loans for infrastructure lending, then we call it as infrastructure finance company. So 75% of loans of that company, NBFC, are given for infrastructure loans. And its net owned funds should be 300 crores. And 75% of income also coming from infrastructure loans only. So one is their assets 75% in infrastructure and income also 75% from infrastructure. These two aspects. And it has net owned funds of 300 crores and it has minimum credit rating A and equivalent and its capital adequacy ratio is 15%. This is classification for infrastructure finance companies. And systematically important core investment company. We call it as core investment company. Whom we call it as core investment company? Any NBFC, if it deploys at least 90% of its total loans in their associate concerns, sister concerns only, not for outsiders. Only their group companies they are investing. So any NBFC investment company, if it is giving loans or if it is investing in shares, bonds, debentures, etc. of its group companies, then we call it a systematically core investment company. So 90% of their all loans or assets are group company loans, debentures, bonds only. And again, not less than 60% of its total assets, equity shares of group companies. That means total 90% it is investing in group companies only. Out of 90%, at least 60%, minimum 60% is group company shares. That means it has invested in group company shares. Then we call it as systematically important core investment company. And its asset size is 100 crores and above. Next, infrastructure debt fund. What is this infrastructure debt fund? Some NBFCs separately, they have started in SPV, special purpose vehicle, infrastructure debt fund. And this infrastructure debt fund, what it will do? It will collect funds from public by issuing bonds, minimum 5 years maturity bonds, either local funds or from abroad also, they will collect. And these funds they will give as loan for infrastructure. This is the duty of this NBFC. We call it as infrastructure debt fund, IDF NBFC. And NBFC microfinance institutions here again. Microfinance institutions. Microfinance institutions. Now we have seen the definition also. If you are giving loans up to 3 lakh rupees for poor people, where it is classified under microfinance. And this NBFC is giving 60% of its loans, it is giving for this microfinance activities. That means poor people. And earlier it was the guideline is 75% of this MFI loans are given. And this NBFC MFI's loans 75% are qualifying assets we call. What is qualifying asset again? They have given loan for this poor people. And first maximum repayment is 24 months and rate of interest is not exceed like that. They have given guidelines for this NBFCs. Why they have given guidelines means for NBFC MFI, there are no much restrictions. We can lend a little liberally, not like other NBFCs. Because RBI has given some leverages. And again, condition is that at least 75% of their assets should be qualifying assets. Now the criteria is reduced to 60%. This current year change and important for current year exam also. Instead of 75% qualifying assets, now they call us 60% microfinance loans. If that NBFC is giving 60% microfinance loans, then we call it as NBFC MFI, microfinance institutions. Right? Next one, factors, NBFC factors. What is factoring again? Factoring means purchasing book debts. That is called factoring. And if they purchase the inland book debts, it is called factoring. If they purchase abroad, that means debtors abroad, then we call it as forfeiting. Inland bills means normally we will also finance against book debts. OD against book debts we will give. In OCC also against stocks and book debts we will give. But NBFC factors, what they will do, exclusively they purchase book debts only. Exclusively. Their business is purchasing book debts, maintaining book debts, collection of book debts, etc. So then we call it as NBFC factors. Factoring activity, as I told you, it is inland bills they will purchase. And its period, normally they purchase this debtors up to 90 days or maximum 180 days. That is why it is short-term financing we call. Factoring, it is short-term finance because up to 90 days book debts or 180 days debtors only they will take. And what about forfeiting? It is 1 year or more than 1 year because normally whenever somebody is buying machinery from foreign country, that supplier may extend time to this person. Say every year you pay some 20% of this cost of machinery. In such cases, what will happen? That person who has supplied machinery, he will raise bills and he will sell it to factoring company. That means what is the benefit here? Immediately they will receive receivables. Normally receivables we will receive after 90 days or 180 daars. In case of abroad, yearly we will be receiving long time. But here immediately they will receive whatever the receivables are there. So purchasing the good debts, we call it as factoring. If it is abroad again, international, then it is forfeiting. So here, what is the definition of this NBFC factoring? At least 50% of its total assets and 50% of income from factoring business only. That means this NBFCs out of total loans, 50% of their loans are given for factoring activity. Right? Next, mortgage guarantee companies. Here, at least 90% of their loans are given for mortgage business. Mortgage business. Then we call it as mortgage guarantee company. And again, here also its net own fund is 100 crores. Okay. Next, NBFCs other than NBFC MFI, they cannot extend microfinance loans exceeding 25% of total assets. This is again current year change and important for this year exam. Normally, any NBFC, they can lend loans, microfinance loans, no restriction. Earlier restriction was, Reserve Bank restriction is that NBFCs, those giving loans to microfinance institutions, only NBFC, MFIs they can give. Other NBFCs, other than MFIs, they can give maximum 10% of their total loans only. It should not exceed 10% of their total loans. But current year, the 10% is enhanced to 25%. That means any NBFC, they can give microfinance loans up to maximum 25% of their total loans. Their total loans we call as total assets. So this is current year enhancement from 10% to 25%. And NBFC non-operative financial holding company. This NBFC non-operative holding company normally for any starting any bank, first they start NBFC non-operative financial holding company. Through this, they will get license for starting a new bank. Right? Next, total borrowings of NBFC is restricted to 16 times of their net owned funds in case of NBFCs owned and controlled by central or state governments, and 12 times of their net owned funds in case of AAA rated NBFCs, maximum 10 times of their net owned funds in case of AA or A rated NBFCs. That means maximum loan to a NBFC, how much we can give. Earlier we have seen its net owned fund should be 100 crores, and in case of infra, it is 300 crores like that. In such cases, that is their own fund is 100 crores. So here 10 times means we can maximum sanction 1000 crores only to that NBFC. And 16 times of net owned funds in case of housing finance companies regulated by National Housing Bank. And another condition for here also, minimum asset coverage ratio for financing NBFCs is here. Generally, it should be 1.25. What is this asset coverage ratio again? Assets divided by total outside liability. What is this assets of NBFC? How many loans, how much loan they have given? Total loans of NBFC, it is called as total assets of NBFC. Divided by outside liability. That means this NBFC has raised loan from banks or other outsiders. So how much loan they have raised? Numerator is total, the total loans, whatever loans given by NBFC is numerator. Denominator is the NBFC has raised loans from outside, banks and others. That is denominator. It should be at least 1.25 while financing loans to NBFCs. But it can be reduced to 1.10 in case of NBFC MFI, or it is a AAA rated, then 1.10 only. It is a double rated means 1.15 and A rated 1.20. This is about NBFC financing. Next, we are going for lending to software. While lending to software, margin on computer hardware as well as fixtures, etc., it should be 40 to 50%. Why margin 40 to 50%? Whereas for other loans, it is we say 25% or 30% margin. But here we are telling 40 to 50% margin. The reason is this computer hardware, it will be becoming obsolete because technology will be changing very frequently. So within short time, it will become obsolete, not useful. That is why as early as possible, our loan is to be closed. So we prescribe margin higher, that is 40 to 50% margin. And repayment also normally 3 to 4 years only we will give, not 5 years, 7 years like that. And the margin on hardware, it can be reduced to 25 to 30%. Instead of 40 to 50%, it can be reduced to 25 to 30%. But provided, what is the, how, when we can reduce? Suppose if there is tie-up arrangement with the supplier for upgradation of technology, frequently upgradation of, that means whenever technology is changed, this computer hardware also they will go on changing. In such cases, yes, margin can be reduced. Or there is a buyback arrangement. Sometimes what suppliers will do, Arey Baba, you take this computer, after 1 or 2 years, again we will take back your computer and we will give you a new one. So buyback arrangement, if such type of arrangement is there, there also we can reduce margin to 25 to 30%. And for financing producers of feature films, cinema people, for producers of feature films, here, the main criteria is they should have good track record at least 5 years and no defaults with NFDC, National Film Development Corporation. Also, sometimes they will be extending loans to these producers. So they should not be defaults with the NFDC, number one, and 5 years good track record. This is eligibility. And how much loan we will give? Out of the total project cost, 35% only our loan, and margin is 65%. Out of margin, the promoter's margin is 25% and 40% as advance from distributors. Normally, this producers what they do while producing films, they take advance from distributors. So 40% is advance from distributors and 25% is promoters margin. Total 65% is margin, 35% is our finance in case of feature films. Regarding bills discounting generally it is part of our working capital assessment. While assessing working capital, we have to include bill discount facility also, ODOCC and also bill discounting. Both put together we will assess and we will fix the limits. Next, borrowers who are having sales turnover over 50 crores, they shall disclose aging schedule. What is this aging schedule? Since how many days the debtors are outstanding, this is what aging schedule. Since how many days debtor is outstanding. So those details they have to give wherever their turnover is 50 crores, over 50 crores. And bills discounting under LC, BULC we call, it is treated as exposure on the LC issuing bank. Normally, if you are giving loan to a borrower, it is exposure on the borrower and risk weight will be calculated basing on rating of the borrower. But if you are discounting bills under LC, BULC, bills discounting under LC issued by some other bank, against that you are discounting. Suppose if it is not realized on due date, we will invoke from bank and bank will pay. That is why we treat it as exposure on the LC issuing bank only. If LC issuing bank is our bank only and we are discounting that bill, in such case, the exposure is on borrower, right? Next, STCLs. Here, short-term corporate loan. What is this short-term corporate loan? For good corporates to meet a temporary mismatch of their financials. Any purpose, whether they can use it for fixed assets purchase instead of term loan, or they may use it for working capital for purchasing raw materials instead of our working capital loan, or they may pay to suppliers, whatever it is purpose, we call it a general corporate purpose or temporary mismatch in their cash flows. For such loans, for such mismatches, we will sanction short-term corporate loans. But they are not at circle level also we cannot sanction, only at head office level it will be sanctioned, STCLs. Okay. What is the here purpose? Only to parties with good track record, and for Indian corporates to the giant ventures also we will fund, and wholly owned subsidiaries abroad also, and within the prudential cap of 20% of unimpaired capital. For this also STCL, maximum loan how much we can give during this year, that is 20% of our unimpaired capital funds, tier 1 and tier 2 funds. And for this maximum prudential cap, earlier Bank was only giving internally, but now circulars they are giving. How much maximum STCL we can give? Recently also the circular has come about 40,000 crores or 50,000 crores. They have given figure. So within that figure only we can sanction these STCL loans. Right? So here two types STCL loans. One is secured STCL, second one is unsecured STCL. Secured STCL maximum tenure is 12 months only. That means within 12 months the loan is to be closed. And the first time we will permit maximum 6 months. It can be roll over by another 6 months. So with that maximum 12 months only, it will come. And the sanction, whenever we are sanctioning STCLs, they have to avail the loan within 3 months from date of sanction. So 2 point only for exam purpose here. Maximum tenure is 12 months, but we will give 6 months time first, and it will be roll over by another 6 months. After completion of 6 months, again one more rollover. So then it is maximum 12 months. They have to avail within 3 months. Unsecured STCLs. Normally, unsecured STCLs means it is a big loans unsecured. That is why we will not give just like that. Only to profit-making public sector undertakings and also government organizations we will give unsecured. Secured we will give to good corporates, but unsecured only to profit-making PSUs and government organizations only. And moreover, unsecured STCL sanctioning powers also MC, Management Committee. And maximum tenure is 6 months only here. And the loan sanctioned, they have to avail within 30 days of sanction and in not more than 2 tranches. Tranche means each disbursement. So 2 disbursement maximum we can do this loan. And within 30 days, they have to avail from the date of sanction. This is unsecured STCL. And third one is corporate loan scheme here. What is this corporate loan scheme? It is a medium term. Earlier, we have seen unsecured 6 months and secured STCL 12 months. But here, 60 months repayment period we will give. This is also similar loan, corporate loan scheme. And here purposes you can see this year they have added this purpose also. For all general corporate purposes. Again, as I told you, they may utilize for any purpose for their business. Credit facilities to Indian joint ventures or wholly owned subsidiaries abroad. For STCL, same purpose here also in terms of extent RBI guidelines. This current year they have added. Joint ventures and wholly owned subsidiaries, it was not there for corporate loan scheme earlier. Now they have added this current year. So here maximum repayment is 60 months, sanctioned by CAC of board and above. Right. Next, consortium advances. Consortium advances, multiple arrangements, syndication of credit, and another one is JLA. So 4 types of arrangements are there. We will discuss one by one, these 4 types of arrangements. Consortium. What is this consortium loan? Suppose borrower needs 1,000 crores. One bank cannot give, maybe the exposures, etc., etc. So in such cases, what happens? 2, 3 banks will finance a borrower. In consortium, that is what arrangement. In consortium advances, what happens is there will be common documentation and common security will be there. Common security. All guidelines, etc. Generally, they follow same rate of interest, etc., etc. Only thing is classification of advance basing on individual bank's recovery. Suppose Canara Bank has given and recovery is good. Yes, it is performing asset with us. Similarly, Union Bank of India also has given, say under consortium, it is also a member, but there is no recovery with them. It will become NPA, no matter. So basing on individual banks' recovery, we will take classification. This is about consortium advances. So what our policy says, there should be participation of at least 10% of total fund-based limits from each member. There may be 4-5 members, but each member should have at least 10% of total fund-based limits. Again, this is also not strict guideline. It may vary also. It is general guideline, 10% it should be there. And coordinated approach and sharing of information, sharing of pro rata business. Any further business also, they have to share pro rata basis. This is about consortium. Next, multiple banking arrangement. What is this multiple banking arrangement? Earlier example we will see. One person need 1,000 crores. Out of 1,000 crores, consortium is not formed. So he has approached Canara Bank. Yes, we say we will give 300 crores. Again, he will go and approach it another bank, Union Bank of India. They says, yes, we will give another 200 crores. And he will go to again State Bank of India. He will give 500 crores. Like that, different banks party will go and approach and take finance. This is called multiple banking arrangement. So here, what are the guidelines? First one is pari passu charge over the security hypothecated. What is this pari passu charge? Pari passu charge means in proportion to your loan amount, we will have security charge. Security charge. Earlier example, we will take 1,000 crores is loan amount and security also for understanding 1,000 crores is security. Canara Bank has given 300 crores. So out of 1,000 crores, 300 crores means 30% is our finance. In security also, we will get to 30% rights. Similarly, State Bank of India has given 500 crores. That means 50% of total loans they have given. In security, they will have right up to 50%. This is what pari passu charge. In proportion to our lending, we will get to charge on the securities. Next, second line is there will be quarterly exchange of information. Even consortium also it is there. Here also it is there among financing banks. And next is chartered accountant certificate half yearly for compliance of statutory guidelines. Reserve Bank of guidelines, what are their statutory guidelines? They says there are no employee provident fund overdues, etc., etc., and there are no taxes arrears with the government. Like that, some guidelines are there. Those guidelines they have fulfilled, complied. Like that, chartered accountant has to give certificate. Half yearly, we have to give this. They have to submit this certificate in case of MBA. And the next one is declaration about credit facilities enjoyed with other banks to be obtained duly certified by auditors. What is this credit facilities enjoyed? Suppose party is coming as for renewal or enhancement or fresh sanction or ad hoc, whatever purpose, their party has to give declaration stating that yes, I am enjoying facilities with other banks this much, like that he has to give. This is what declaration about credit facilities enjoyed with other banks. It should be obtained duly certified by auditors every time renewal or enhancement, etc., etc. Right? Next, giant lending arrangements, JLA. This is third type of arrangement. What is the giant lending arrangement? About 4 or 5 years ago, Reserve Bank has told MBA is a little bit becoming difficult because there may not be control, etc., etc. So better there will be some type of arrangement where some supervision will be there, good supervision will be there. Like that, Reserve Bank has told what is the guideline for JLA? Reserve Bank has given single borrower with aggregate credit limits, both fund-based and non-fund based, 150 crores and above, involving more than one public sector bank. Suppose a party is enjoying 200 crores with two banks, then compulsorily they have to form joint lending arrangement instead of MBA. This is what guideline given by Reserve Bank of India. So here, cutoff point for JLA is 150 crores and above for formation. And the non-investment grade, that is not good rated borrowers. For less than 150 crores also, they can form joint lending arrangements. So this is third type of this JLA. And the next one is there syndication of credit. Syndication. What is this loan syndication? This also we will cover. What is this loan syndication? Here, same example we will take. Party needs 1,000 crores. Party will bring his project report to Canara Bank. For example, we will take. Party has come and approached Canara Bank. Baba, I need some 1,000 crores for this is my project report. So he has given mandate to Canara Bank, you sanction full loan or you may arrange some portion from other banks also. So the mandate is given to Canara Bank by the borrower. Now Canara Bank is called as mandated bank in syndication. Mandated bank because borrower has given mandate. Yes, you negotiate on my behalf with other banks. So what Canara Bank will do, basing on their project reports, we will prepare information memorandum. All financials are like that because this information memorandum will be circulated to other banks. Yes, we will go and approach some State Bank of India. This is the project report of my one of my this person who has one of my prospective borrower, and he need 1,000 crores. We are ready to finance 200 crores. How much you will finance? Like that, we negotiate with different banks and arrange full amount, including our bank. Sometimes even our bank may not sanction. We will arrange with other banks. Then what is the use for us? Why we have negotiated? We take some commission for arranging finance. Mandated bank we call. This is called loan syndication. So four types of arrangement we have seen. Now time frame for issuance of NOC or pari passu letters. What is this NOC and pari passu letters and ceding of charge? Earlier example, same example we will take 1,000 crores. Borrower is enjoying with three banks. Canara Bank, State Bank and Union Bank. Borrower is enjoying. He need another 200 crores. So first he will ask these three present banks whether you will give like that. We says yes, yes, no, we will not give. You go and approach some other bank. So party has to go and approach some other bank. That bank just like that they will not come. First they will ask the NOC because already three people they have financed. They ask the NOC. For giving this NOC, guidelines are given periodicity. This much period maximum like that days. Within how many days banks has to give NOC? These guidelines are given by Reserve Bank of India. This is what issuing NOC letter or pari passu letters. So while granting additional facilities by existing banker or new banker in a consortium or MBA, they should communicate and complete NOC process before disbursement. Once the NOC is given means we are ceding pari passu charge also with the new bank. That means after new bank induction, total 1,200 crores total loan will become, and total security also will become 1,200 crores, and new bank will get 20% to share in the total security. This is what pari passu charge they will get. So NOC, what is the periodicity for this NOC? First, borrower has approached lead bank. Here, three banks are there. Lead bank is State Bank of India in our example. So borrower has approached State Bank of India. Yes, some other fourth bank is coming. You give NOC. What State Bank of India will do? They convene meeting with members. For convening meeting with members, 15 days time is required. This is first one. When borrower has submitted letter for additional finance, from date of receiving letter, within 15 days, this lead bank has to conduct a meeting. So in meeting, they have taken decision not to give NOC, so they can reject it. For that means for rejection, maximum 15 days time is there. Now, yes, they says, yes, we will give NOC. They have taken decision. Then what lead bank will do? It will take up with its head office, higher office for sanction of this NOC. For sanction of this NOC. For that 30 days time is there. So 15 days for convening meeting and the next 30 days for lead bank for their sanction. So here total how many days? 45 days it has come for lead bank. So for seeding NOC, for giving NOC letter or seeding pari passu charge for lead bank, maximum 45 times time is there. And after sanction by lead bank, what it will do? It will ask other member banks also. So our higher authorities has sanctioned the NOC. You also get sanction from your higher office. So for member banks, another 30 days time is given for sanction. So how many days total here? 45 plus 30, 75 days total period for member banks. So here, what is the total period for completing pari passu charge? 15 days for meeting, 30 days for lead bank, another 30 days for member banks. Total 75 days. So maximum period for issuing NOC or pari passu is maximum 75 days only. Objection within 15 days. So this is time norms for this. And scheme, there is a scheme for financing Indian companies for acquisition of equity in overseas companies. So our Indian company, they may acquire equity in overseas companies. In such cases also we will finance, but here conditions are good rated corporates, AAA or LR1 or LR2 corporates only. The tangible net worth 100 crores and above as per latest ABS. That is first condition. And second one, loan quantum minimum $1 million and maximum amount is twice the tangible net worth of the company. And it is a term loan in Indian rupees or in foreign currency we will give. Maximum repayment period is 60 months and 72 months in exceptional cases by sanctioning authority. This is scheme for financing Indian companies for acquisition of equity in overseas companies. Next, FCLR loans, foreign currency loans to residents. Local people, they may require loan in foreign currency. In such cases, we will give. But three currencies are permissible here, FCLR, USD, GBP, and Euro. Three currencies. So here, other than PSUs, we require collateral security, 125% collateral security we require for sanction of this FCLR. And the minimum loan amount should be equivalent to $150,000 in case of working capital loans or term loans, or $50,000 in case of short-term import financing. So here, how much loan we will give? When the foreign currency loan to residents, $150,000 for either term loan or working capital, and $50,000 in case of short-term import financing. And the FCLRs, they can be given for liquidation of existing rupee term loans also. So local borrower has raised term loans. For closing those term loans, they may require FCLR. In such cases, the residual loan tenure should be less than 5 years. This is foreign currency loans. Three currencies, 125% collateral, $150,000 for term loan and working capital, and $150,000 for term loan or working capital, and $50,000 for short-term import financing. Right? Next, FCLRs to NBFCs also we will give, non-banking finance companies also. They are also AAA rated NBFCs. And maximum quantum $5 million, repayment working capital 1 year and term loan 3 years. This is for NBFCs financing foreign currency loans. And OPL, regarding OPL, when OPL will come, suppose a bank is financing to a new borrower, normally they insist for OPLs. Nowadays, this concept is going gradually fading because all your online you will get all credit information reports, but still OPL's practice is there. Here we will not mention, while giving OPL, we will not mention actual figures. So here we have to give fair. Fair means 10 to 25 lakhs worth this borrower person. Then we will mention simply fair. Or good if you mention it's worth of 25 lakhs to 1 crore. And if you mention very good, their worth is 1 to 10 crores. Large means 10 to 25 crores. Very large means above 25 crores. So we will not mention figures. We will only mention words. Basing on that, other bankers also will understand what is the worth of this person. Okay. Regarding secured ODs, now at least you have to take stock statement once in 6 months. That is only important point for security. And infrastructure investment trusts, InvITs, it is a new concept. About 2 years ago, it is started. Infrastructure investment trusts. What is this InvIT? Just like mutual funds. Just like mutual funds, it works. How mutual funds will work? What mutual funds will do? They pool money from various investors and invest that money in different companies. This is what mutual funds will do. Similarly, this InvIT also will do same job. They collect money from different people, agencies, etc., and invest in infrastructure companies. Particularly, investment means it is purely for acquiring promoters' stake, mainly for acquiring promoters' stake. That promoter stake means it is not for creation of additional assets. Suppose one person, he has started some power project. He has constructed and started one power project. So power is generated, he is getting income continuously. He want to sell some equity to others in his out of his total equity, whatever his stake is there in the business, he want to sell some stake to others. In such cases, this InvIT will buy that stake. We call as investing in or acquiring promoter's stake. Say his stake is 1,000 crores, his principal investment is there, this capital. Out of that, he want to discern half. So 500 crores, it will be given by this infrastructure IT and acquire 50%. So what is the benefit for this InvIT? Whatever profits is generated in that power project, 50% is its stake, so 50% will be given to this InvIT. That means nothing but this InvIT will become part owner of that infrastructure. This is how the mechanism. So here conditions are first one, financing to InvITs is primarily for acquiring promoter stake. You know, our finance they will use for acquiring promoters stake here. And our finance should be restricted to 50% of finance required. So in earlier example, they need 500 crores for taking stake in the power project. So we will sanction maximum 50% of that, means only up to 250 crores only we will sanction, we will finance for this. It's only example because again maximum we cannot give more than 100 crores to this InvIT, right? And the next one, the holding of the InvIT in the underlying assets should not be less than 1,000 crores and the net worth of the company should be 1,000 crores. That means simply if immediately the InvIT is started, it is not having its own funds, then we cannot finance. It should have at least 1,000 crores its net worth. And this 1,000 crores already it has invested in some assets. Then only we will finance. The aggregate exposure ceiling for financing is 1,000 crores. That means for all InvITs, bank as a whole, we can sanction only 1,000 crores only loans. Out of that, individual InvIT is 100 crores only. What is this 100 crores? Again, as per our prudential exposure norms, Reserve Bank of India has given prudential exposure norms to avoid concentration risk. It will come subsequent slides. It will come prudential exposure norms. So the prudential exposure norms of Reserve Bank of India for sanctioning trusts and associations other than hospitals, etc., education institutions, then maximum we can sanction only 100 crores. For any trust other than hospitals and education institutions, we can sanction maximum 100 crores only. So here that norm will apply. So maximum to individual InvIT, we can sanction only 100 crores only. And other guidelines, margin should be 50%, debt equity ratio 1:1, debt service coverage ratio 1.50, it may be reduced to 1.25 by sanctioning authority, repayment to maximum 7 years. And classification, how you are classifying it is, if it is an infrastructure loan or it is for capital assistance. Capital assistance, when the party, if this party is acquiring owner's equity, then our loan will become capital exposure. Or if he is investing in infrastructure company, then our loan will become infrastructure. Okay. Next, the trust is required to invest at least 80% of value of InvIT in completed and revenue generating projects. While acquiring owner's stake by this InvIT, this compulsorily it has to see if it is project is completed and income is being generated. In such companies, at least minimum 80% of its investment should be completed projects. And not more than 10%, it will be in investments in under construction projects. Completed volume 80% they have to invest. Under construction, maximum 10% only they can invest. This is briefly about InvIT. About 2 years ago, it is introduced. Next, interbank participation certificates. What is this interbank participation certificates? Some banks, what they will do, securitization of their loans. Securitization means bundling loans and selling to some other banks or financial institutions. This is what we call securitization. Suppose one bank, say one private sector bank is there, say Axis Bank. Axis Bank, it wants to sell 1,000 crores of its retail lending portfolio. What they will do, this 1,000 crores they will bundle and sell it to other banks. by way of this interbank participation certificates. So each certificate, they may say 1 crore certificate or 10 crore certificate like that, and it will be given. This is what interbank suggested. And similarly, another certificate is also there. We call it as priority sector lending certificate. Similarly, what is this priority sector lending certificate? Say our bank is having shortage, say Axis Bank is having shortage of priority sector. Reserve Bank says 40% of their loans should be given for priority sector. Only 35% of their loans are given, 5% is short. 5% means approximately 5,000 crores. Approximately we say. So they need 5,000 crores priority sector loans. Canara Bank is having surplus of 5,000 crores priority sector loans. So what we will do, we will sell it to Axis Bank, this 5,000 crores extra priority sector loans by way of certificates. It is called priority sector lending certificates. It is nothing but securitization. So for this interbank participation certificates, the period is 91 days to 180 days with risk sharing and 90 days without risk sharing. IBPC issued by banks with minimum capital ratio of 10%, capital adequacy ratio of 10%. They are eligible for subscription to IBPC by our bank. That means the IBPC selling banks, its capital adequacy ratio should be minimum 10%. Then only we will purchase the IBPCs of that bank. Next, co-lending by banks and non-banking finance companies, including housing finance companies to priority sector. Co-lending. This co-lending, what is this co-lending again? Say one NBFC is having vast presence in rural areas. And our bank, they want to give loans in rural areas, but our presence is not there in that much interior areas. So what we will do, we will tie up with that NBFC. We says, yes, NBFC, you give loans in that area. And a portion of those loans you transfer to us. There will be agreement initially between our bank and that NBFC. Initial agreement will be there. So as per that agreement, we will take portion of that loan. This is what co-lending. So first NBFC, what NBFC will do? It will identify borrower, it will sanction loan, it will disburse loan. After disbursing loan, they will transfer a portion as per our agreement. This is what co-lending. Suppose if they are giving loans, priority sector eligible loans, agricultural loans, SHG loans, etc., which are qualifying under priority sector, and a portion of those loans are transferred to us, we will also classify our portion under priority sector. Right? So here condition, what is this condition? Till last year, the NBFC, whatever loans they have given, they have to retain at least 20% of those loans, and maximum 80% only they can transfer to us. That was earlier condition. But current year change is that minimum 10% they can retain, and minimum 10%. It may be 20% also, but minimum 10%. Earlier, minimum 20% was there. Current year change is that minimum 10% they have to retain, and the remaining they can transfer to us within 15 days. Again, this also the Reserve Bank has told. Within 15 days from the date of creation of that loan, they have to transfer to us. This is co-lending arrangement, right? Of course, digital lending, here again, regarding digital lending, it is of online loan. Here, important point is 2-3 points here. Suppose if you are giving loans through some intermediary, then that intermediary's name, etc., we have to publish in our website. That is one. As agent of our bank, they are lending, digital lending. And here RBI guidelines important one. One is a key fact statement here, KFS we call. Key fact statement means we have to give the statement to the prospective borrower in simple, understandable language, stating that all terms and conditions we have to mention, including annual percentage rate. Second one, what is this annual percentage rate? What are all total charges, including interest, or your processing charge, etc., whatever charges are there, we have to mention total. This is our annual percentage rate, all inclusive cost and margin. That means it is pricing. Why we have to disclose party to take decision? Is it correct rate, annual percentage, interest, charges, etc.? Basing on that, party will take decision whether to take the loan with this bank or any other bank where they may get at lesser rate. This is what APR. So key fact statement, total terms and conditions we have to give in understandable language. Second one, annual percentage rate, total interest and other charges, total what we are charging to the borrower on this loan we have to give. That is called annual percentage rate. Next, cooling of lookup period. What is this cooling of lookup period? After sanctioning this loan, party will have time whether to accept this loan or to reject this loan. This is called cooling off or lookup period. This cooling off lookup period is minimum 1 day if loan is repayable in 7 days or below, less than 7 days. If loan is payable in more than 7 days, minimum 3 days is lookup period we have to give. This is lookup period also. So 3 points here. And the next one is default loss guarantee. What is this default loss guarantee? Out of total loans, whatever it is disbursed by particular agent, our agent, they will be disbursing on behalf of us. And again, co-lending it is. Again, co-lending, just like earlier we have seen NBFC co-lending. Similar here also, but digital platform. So whatever loans they have disbursed, if there is a failure of that loans, up to 5%, it should not exceed maximum 5% Reserve Bank guideline. Up to 5%, they have to bear that loss. This is what default loss guarantee. And just like they are giving guarantee, yes, up to 5% we are giving this guarantee. Suppose if there is loans are failed, they have become NPA, then we can claim up to 5% from that intermediary. That is our giant lending person, other person. Okay. This is about co-borrowing, co-lending. Yeah. Now we are going for operational process and systems. Regarding operational process and systems, what we are going to do at branch level. Earlier, we have seen broad guidelines, strategy guidelines. Now we are going for operational process and systems. What at branch level or at unit level, what we are supposed to do. In respect of all credit proposals, 1 crore and above, relationship and appraisal different. Relationship means our marketing people will go and approach, and appraisal will be done at branch level and circle level, whatever it is. So relationship is separate and appraisal also separate. This is compulsory for 1 crore and above. Your all small loans people, it will be same person, but for 1 crore and above, it should be separate. This is what as per our policy. And regarding submission of credit proposals, large corporate branches, they can submit CO powers directly to CO. HO powers also they can submit directly to HO and endorse a copy to CO. And what CO will do, within 2 days, they will send the front sheet with their recommendations to HO. This is to reduce turnaround time. Normally, higher official, suppose earlier what was the procedure? HO power accounts. First it will go to CO. CO will again send it to HO. Now directly they can send it to HO is a copy to CO. CO will send their views to HO within 2 days. And similarly, submission of credit proposals by branches falling under the sanctioning power of circle office. Branches to circle powers. Directly branches can send to circle and a copy endorser to RO. RO will send their views within 2 days. And similarly, MSME proposals beyond cumulative cutoff limit 25 lakhs or branch delegated powers, whichever is less, they have to send directly to sanctioning authority. This is all system process only. And participation of bids or quoting of rates. This is bids or quoting of rates. What happens is at HO level, Suppose one public sector undertaking or public sector company, they want some finance. What they will do? First, they will ask different banks. Are Baba, we need amount. What is your rate, interest rate, processing, etc., etc. You give quotation. Basing on that, we will take. Like that, they will ask for quotation. This is what participating of bids. So different banks will give quotation. Wherever it is cheaper for them, they will go and take from that bank. So here the powers is ED up to 300 crores. They can give this quotation. MD beyond 300 crores, they will give this quotation. Next, regarding submission of balance sheet, when they have to submit, this is also another, recently they have started about 2 years ago it has come, and already it has come in exam also. For availing credit facilities, either fresh or additional or renewal, which balance sheet we have to take compulsorily? Suppose what is current financial year? 25-26. This is current financial year. This is T, we call. Current financial year is T, 25-26. Now party is coming and approaching us for finance. We need balance sheet, audited balance sheet. Which financial year audited balance sheet he will give? Now T minus 2. Why T minus 2? I will tell you. Normally, for submission of balance sheet, what is the norm? 7 months from close of financial year, they have to submit. Or within 15 days from the date of adoption of account, or 7 months from closing of financial year. For us, financial year is 31st March. 7 months means October 31st is cut-off date. So party has to submit audited balance sheet latest by 31st October. Which audited balance sheet? 24-25, previous year balance sheet. They have to submit by 31st October. But now September only. Still time is there for submission of balance sheet. Then which balance sheet he has to give? Not 24-25. 23-24 balance sheets audited they have to submit. That is T minus 2. Current financial year 25-26 is T. Previous year is 24-25, T minus 1. Another previous year, T minus 2 is 23-24. So the party can submit 23-24. So T minus 2, this is norm. Suppose party is approaching after November. This November party has approached 25-26. This is current financial year. Party has approached after 1st November. Then compulsorily he has to submit previous year's audited balance sheet because that is T minus 1. This is because current year is T. Previous year T minus 1. So T minus 1 balance sheet party has to submit. This is the norm. Right? If audited balance sheet submitted is more than 6 months old, suppose at the time, what we have to do? More than 6 months old audited balance sheet. So latest to provisional financials we have to call for and obtain. Latest to provisional financials we have to take. If it is more than 6 months old. Next, ABS need not be obtained from borrowers for seeking crop loans. Agricultural loans normally up to 1 crore we should not insist. And beyond 1 crore, RO, CSC and above authorities they will waive. But additional premium 0.25% interest we have to load for non-submission of this balance sheet. Next, corporates will be submitting us balance sheets. That is financial statement, audited balance sheet, profit and loss account. Companies, they will submit periodically. We have to verify this balance sheet through Ministry of Corporate Affairs website. All these balance sheet compulsorily they have to submit to MCA. It will be available in MCA website, Ministry of Corporate website website. We have to verify the balance sheet submitted to us and balance sheet in MCA website, whether same or any changes are there like that. And the next one, chartered accountant will be signing. They have to mention UDIN number. What is this unique documentation identification, unique document identification number? Chartered accountant, while signing this balance sheet, they will give UDIN number on this balance sheet or any financial statement. And this will be uploaded in UDIN portal of Chartered Accountants Institute of India. ICAI separate portal is there. All chartered accountants, what are certificates they have given with UDIN number, they have to upload in the ICAI website. So there we have to counter check. This is second check. MCA website and UDIN portal. 2 ways we can check. And further, In case of proposals wherein the limits above 5 crores, a copy of passport of the promoter we have to obtain. Promoter's passport copy. And suppose promoter says, sir, I don't have passport, I have applied. We have to take undertaking letter. Whenever he receives his passport, we have to compulsorily, he has to submit to us. That we have to obtain, right? Next, legal entity identifier. It's a 20-digit alphanumerous code. We have to obtain. They have the parties, non-individuals, compulsorily they have to obtain. Earlier cut-off dates they have given. Now cut-off dates all over because from 30th April 2025 onwards, 5 crores and above, compulsorily all non-individual borrowers they have to submit. Previous cut-off dates are overall. Now, after April, that April also over. Now, all non-individuals with exposure of 5 crores and above, compulsorily they have to submit LEA, legal entity identifier code. And for all proposals, we have to enter this name in the first page itself, LEA code number. Next, report from Central Economic Intelligence Bureau to be sought for exposures above 50 crores wherever prospective borrower. Suppose new borrower comes 50 crores, above 50 crores, they ask. You have to call for report from Central Economic Intelligence Bureau. This is compulsory. And similarly, any borrower accounts exceeding 50 crores, it becomes NPA. There also you have to obtain report from Central Economic Intelligence Bureau. Next, assessment of group risk. Actually, while processing proposals, we have to assess group risk also. Here, what is this group risk assessment? Mainly key financials. What are those key financials? Turnover, net profit, leverage, that is TOL to TNW, liquidity, etc. Of major concerns are group companies or joint ventures holding above 30% of paid up capital in all accounts, and also where corporate guarantees are stipulated shall be incorporated in the episode. Suppose you are processing one corporate loan proposal, there you have to incorporate financials, main financials of the group companies also to assess the group risk. Which companies? Wherever this company is holding above 30% paid up capital in subsidiaries or group companies. Apart from that, wherever they have extended corporate guarantee, it shall be incorporated, right? So what we will do is assessment of working capital and methods are there, three methods. It is already 11:45, 5 minutes. We will take tea gap, 5 minutes. After 5 minutes, we will continue so that a small gap will be there. So 5 minutes gap we will take. Yeah, yes, sir.
Sir,
5 minutes gap we will take, sir. Tea break, and we will continue.
please, sir.
Yeah, yeah. Yeah. Yes, sir. Shall we start, sir?
Sir, please, sir.
Yeah. Yes, friends. So, three types of working capital assessments. First one is turnover method. Working capital assessment, first one turnover method. Turnover method. In this turnover method, it is otherwise called as PR Nayak committee recommendations. Here, 20% of projected gross annual sales turnover accepted by bank is the working capital limit we will fix. Actually, I will show you so that you will another one turnover method. Yeah. The projected turnover accepted by the bank is 10 crores. Project turnover means next year how much sales they will do. That is what projected turnover, 10 crores. 25% of projected turnover is working capital requirement. So out of the 25% of 10 crores is 2.5 crores. 2.5 crores is the requirement, their requirement, working capital requirement. Out of this requirement, some party has to bring as margin and some we will give as loan. How much party has to bring? 5% of projected turnover, it is prescribed margin. Out of 10 crores, what is 5 crores? 5% here, it is 0.5 crores. So 0.5 crores is the margin. 2.5 crores is working capital requirement, 0.5 crores is margin, and we care to sanction this 2 crores. This is what permissible bank finance. So here we call 20% of turnover. This is what PR Nayak committee has recommended. Here one more point is, suppose available networking capital in the system. If available networking capital system is instead of it here I have given as 0.4 crores. Instead of 0.4 crores, suppose if it is 1 crore, available networking capital in the system is 1 crore. In this case, what happens? Either 5% of projected turnover or available networking capital in the system, whichever is higher, we have to take as margin. Here, higher is available networking capital, 1 crore. So, here 25% working capital requirement to 2.5 crores. Out of that, party is already having 1 crore. So, here our amount will become 1.5 crores. This is what finance. Okay, turnover method we call this. Right now, we go for this turnover. Next one, other points of this turnover method. Simple here, 3 points. One is 20% of projected annual turnover accepted by the bank. That is what working capital requirement. And margin is either 5% of turnover or available net working capital in the system, whichever is higher. And third point is current ratio for this 1.25. And applicability of this is manufacturing and services for up to 5 crores. We will do assessment. That means if any industrial unit, that is manufacturing unit or service unit, if they need working capital up to 5 crore rupees, we can assess under this turnover method. Other than MSC, up to 2 crores only, traders, merchants, exporters, IT, etc. It is up to 2 crores only, we will do under turnover method. And second one, another important point here. However, borrower can opt for either MPBF or cash budget system, and bank can employ if the same is more suitable and appropriate. Instead of turnover method, if they ask for either MPBF or cash budget, yes, we can proceed. Next one is MPBF system, we call as maximum permissible bank finance system. Tandon committee recommendations we call, and second method of lending. Tandon committee second method of lending is applicable here, MPBF system, maximum permissible bank finance system. Here it is applicability first one, beyond turnover. Ante beyond turnover means more than 5 crores in case of manufacturing or services and more than 2 crores in the case of traders, merchants, etc. This MPBF is applicable. And limits over 25 crores, they can be assessed on the basis of either MPBS system or cash budget system at the option of borrower. always borrower's option is final. We have to keep in mind. If they ask for MPPF, yes, you do. Or if they ask for cash budget, yes, it can be proceeded. But in general, MPBF system is very, very valid. That means mostly it will be either borrower eligible under turnover method or borrower eligible under cash budget method. If they ask for MPBF system, you have to do assessment under MPBF system only. So here MPBF system, how we will assess that we will see in MPBF system also. Yes. In MPBF system, how we will calculate total current assets we call as gross working capital. It is 40 crores. Only example we have taken. And less current liabilities excluding bank borrowings. Current liabilities excluding bank borrowings. That means out of total current liabilities, we have to take out bank borrowings. Remaining portion only we have to take. So it is 8 crores. Then comes, it is called as working capital gap, 32 crores. And in exam, they ask like this only, what is working capital gap? That is also another question. Working capital gap, it means total current assets less current liabilities excluding bank borrowings. It is called working capital gap. That means party needs this much working capital, total gross working capital. Out of that, 8 crores is financed by others. Other than banks, somebody has financed. So his gap is 32 crores. His working capital gap is 32 crores. Out of this, what is the margin? 25% of current assets. This is second method. 25% of current assets, it is 10 crores. So this is margin. If you reduce this 10 crores, then 22 crores will come. It is MPPF. But here again same condition. Either 25% of current assets, gross working capital, or available net working capital in the system, whichever is higher, we have to take as margin. So here already available net working capital in the system is 11 crores. Here 32 crores is your working capital gap and 11 crores is already available in the system. And so permissible bank finance 32 minus 11, it is 21 crores. This is permissible bank finance. Suppose earlier example also, instead of 11 crores, here also it is 9 crores only it is there. 9 crores only it is there. In this case, what happens? Margin is 25% of this working capital, gross working capital is margin, that is 10. So 32 minus 10, it will come how much? Sorry, 32 minus 10. 32 minus 10, it is 22. This comes your maximum permissible bank finance. Okay. So here margin is 25% of current assets or available net working capital in the system, whichever is higher, that is the margin. Okay. Now we go for our third one. Cash budget method. Cash budget system. Here, working capital limits are assessed on the basis of projected cash flow and estimated cash deficit. Here, what is this projected cash flow and estimated cash deficit? I will tell you. April month. April month cash inflow is 5 crores. Cash outflow is 10 crores. So here gap is 5 crores. First month gap is 5 crores. Second month, May. May inflows 10 crores, outflows 20 crores. So May gap is 10 crores. Earlier month gap 5 crores, current month gap 10 crores. So now total gap is 25 crores. Like that, entire year they will calculate projected cash flow and whatever deficit is there, that is fixed as limit. That is why we call cash budget system as deficit financing. Because whatever cash deficit is there, that only we are financing. It is called as cash budget system, deficit financing. So here two issues. One, what is the cutoff limit here? Over 25 crores. Borrowers enjoying fund-based limits over 25 crores. This method is applicable, number one. Number two, specific industries or seasonal activities such as software, construction, tea, and sugar. For this, you have to apply cash budget system only, seasonal industries. And apart from that, now NBFCs also you have to assess under cash budget system, NBFCs. And wherever for valid reasons the borrower opts to avail working capital under the MPBF system, here you have to do. Always MPBF system will prevail over other systems. It is powerful. If borrower asks, yes, you have to proceed under. And another one, about 4 or 5 years ago, they have introduced another one. Banks shall finance the discounted net cash flow in the form of term loan, not exceeding 3 years. Against which security again? Against receivables. What are those receivables? Definite cash flow from government entities or AAA rated corporates or credit card receivables where our bank POS machine is installed. That means wherever they are expecting compulsorily some inflows, against these inflows, we will finance in the form of term loan, which is repayable in less than 3 years. Right? That is discounted net cash flows. Next, for construction companies, what is the maximum permissible working capital limits generally should not exceed 9 times of net owned funds. And assessment of NBFCs, I told you already, it is under cash budget method. Next, gold card for exporters, gold card scheme for exporters, standby credit limits. What is the standby credit limit? Apart from normal regular limits, we sanction certain portion as standby credit limits. In case of emergency, they will avail immediately. So in the beginning itself, we will sanction at the time of normal sanction. In case of emergency, they will avail. This is called standby credit limit. For gold card scheme exporters, 20% of their assessed limit we will fix as a standby credit. And they can avail this 20% for a maximum 2 times in a year, each time 60 to 90 days. So here for gold card scheme exporters, standby credit, one is 20% over assessed limits. Second one, maximum 2 times in a year they can utilize. Each time maximum 60 to 90 days only they can avail. And lending on guarantees issued by other banks. Other banks sometimes they may issue guarantee. Why they will issue guarantee? They can very well finance. Sometimes what happens is particular type of industry exposure is more with them. Then they cannot sanction fund-based limit. In such cases, they will give guarantees to borrower. They don't want to lose that borrower. So they will give guarantee. Against that guarantee, we will finance. So here the borrower shall have satisfactory dealings with us. At least 3 years he should have satisfactory dealings. And guaranteeing bank should have fund-based exposure to the party to the extent of at least 10% of the guaranteed amount. Suppose state other bank has given 10 crores guarantee in favor of our bank on behalf of that borrower, 10 crores. So it has given 10 crores guarantee means it should enjoy, the party should enjoy at least 10% of 10 crores means 1 crore. 1 crore fund based limits the party should enjoy with the other bank which is giving guarantee. Right? Next, liquidity and current ratio norms. What is the required current ratio for as I told you, turnover method, PR Nayak Committee 1.25, MPBF that is 1.33, cash budget also 1.33. This is current ratio, it is required. Next, these current ratio norms are not applicable for working capital limits to schools, colleges, hospitals, nursing homes, hotels and restaurants, service providers, infra projects and plantation. For all these activities, this current ratio norms, they are not applicable. And benchmark current ratio is not applicable for sugar industry also. Next, bank has to obtain quarterly cash flow statements in respect of borrowers having working capital limits of 50 crores and above. Our borrowers who are all enjoying 50 crores and above working capital limits with us, we have to call for quarterly cash flow statements. And wherever current ratio is less than prescribed norms, that means either 1.33 or on the less than 1.33 or 1.25 as the case may be. In such cases also, we should call for quarterly cash flow statements for monitoring purpose. Next, this is another 4-5 years back addition. In case of large projects with total over 250 crores and above from banking system, here cash flows, that quarterly cash flows, whatever it is there, it is to be monitored by an agency for specialized monitoring. We call ASMs. Agencies first, they are all chartered accountants. They start some agency for specialized monitoring. So wherever our borrowers are there, 250 crores and above, if they are enjoying, quarterly their cash flows are to be monitored by this agency for specialized monitoring. So we will appoint these agencies and the borrower has to pay them. What are the charges actually? It is 5 lakh rupees for limit up to 500 crores and 8 lakh rupees for above 500 crores. It is payable quarterly. This is what charges we will pay to ASMs. But here applicability is above 250 crores who are all enjoying for their cash flows. Quarterly cash flows are to be monitored by agency for specialized monitoring, right? Quick ratio. Earlier, this quick ratio was not considered for any sanctioning, etc. But 2 years ago, Reserve Bank has told, yes, you also observe this desirable level of this quick ratio. Right? What is the quick ratio again? Your current assets minus inventory. Immediately encashable current assets, whatever is there. So current assets minus inventory divided by current liabilities, quick ratio. So what is the required ratio here that they have given? 0.61 to 0.93. That is what desirable ratios it is given. And it is applicable for MSME borrowers with exposure above 10 crores and now other than MSME above 50 crores, quick ratio also we have to monitor. Next, compliance of sanction terms and conditions we will mention in 482. Fixation of time schedule for working capital. Normally, earlier working capital limits we used to fix based on risk rating of the borrower, but now completely nikal diya. But now all working capital limits we will fix 12 months tenability. 12 months tenability. Only exception is staff OD, GLOD, crop loan, KCC. These are exceptions. For all others, normally working capital limits we will fix 12 months. Some schematic lending like doctor choice, etc., they are exempted. Next, putting through EMT or mortgage transactions. First and second extension. Normally, while sanctioning loans, we say the mortgage is to be completed by so and so period. At the time of documentation, new loans at the time of documentation, we will do. Suppose in case of your housing loans and in big cities, what happens? Immediately documents may not come. So in certain cases, we may have to postpone the mortgage. So in such cases, first and second extension by sanctioning authority for maximum 6 months they will occur. Third extension onwards, next higher authority up to CO powers. And at HO powers, concerned sanctioning authority. If there is a delay, even takeover accounts also, we have to do immediate mortgage. If some problem is there, then extension arise. LSDBC, loan system for delivery of bank credit. What is this LSDBC? This example I will tell you for understanding. Suppose you sanction 200 crores working capital loan OD/OCC to a borrower. This borrower is cash rich person. He will utilize only 5 crores or 10 crores, but you sanction 200 crores. So remaining 190 crores which he enabled, simply you are keeping idle. You cannot give loan to others because of your asset liability mismatch also it will come. So you cannot give loan to others. We don't know when the borrower will draw that remaining amount, 190 crores. Now at present he has not drawn. So Reserve Bank has observed such cases and the Reserve Bank has thought instead of wasting that 190 crores ideally, that parcel, that borrower is not availing and nobody, banks also not giving loan to others. So wasting. Suppose if you divert that to productivity, if you give loan to others, it may increase productivity. So then they have brought the system, loan system for delivery of bank credits. What is this system? It is applicable for borrowers fund-based working capital limits 150 crores and above from banking system. Suppose some borrower is enjoying, earlier example I told you 200 crores one borrower is enjoying. They are applicable to LSDBC. There what we have to do, entire limit don't give as OD/OCC. So minimum level of loan components, WCDL, it should be 60%. What is this WCDL? Just like DPN single transaction loan, we will give. Party has to avail. Say out of 200 crores, 60% means 120 crores WCDL. So party says, yes, 3-4 tranches I will avail this WCDL. he will go on availing first time 20 crores, next time 30 crores, 50 crores, like that, they will avail. It is not ODOCC. And immediately they cannot repay and take it back. Say one installment he has taken for 30 days. So up to 30 days, it will run. After 30 days, he will close. And another limit he has taken for some 50 days, 60 days. After that period, it will also close. That means our asset liability mismatch will not be there. We know that party is availing for certain period. After period, amount will come. That amount we will lend to others. This is the actually intention behind this LSDBC, loan system for delivery of bank credit. Here 2 points. One is applicability 150 crores and above, fund-based working capital limits. Second one is working capital demand loan should be minimum 60% and remaining it will be ODOCC. That is up to maximum 40% only ODOCC. And minimum tenure of loan 7 days, maximum till validity period. Where 1 year we are sanctioning working capital means 1 year it will be. And risk weights for undrawn portion of cash credit. Earlier example, I will tell you, out of 200 crores, 80 crores is your cash credit limit. Out of 80 crores, as on balance date, liability only 50 crores. 30 crores party has not availed. This is what unavailed. On unavailed, what we have to do? We have to maintain capital. For maintaining capital, credit conversion factor 20% we have to multiply 20% credit conversion factor. So unavailed portion is 30 crores. 30 crores multiplied by 20%, it will come 6 crores. On 6 crores, you maintain capital. That 11.5% capital, that you have to maintain for this credit conversion factor. And the Reserve Bank says this unavailed portion unconditionally cancelable or not. What is this unconditionally cancelable? This is again Reserve Bank of India told. Suppose any limit, if unconditionally you can cancel that limit, in such cases, you need not maintain capital on that. No question of credit conversion. Because anytime you can cancel. If party is not availing, yes, you can cancel. That is called unconditionally cancelable limits. But here in LSDBC, even if it is unconditionally cancelable limits, in such case also you have to maintain capital. Hence, you multiply with a credit conversion factor of 20%, and on that amount you maintain capital. This is LSDBC. Next, computation of drawing power. What is this computation of drawing power? Normally, for borrowers, ODOCC borrowers, what we will do? We take stock statements. Out of stock statement, what are all the stocks? On that, unpaid stocks. What is unpaid stocks? Sundry creditors. Sundry creditors is unpaid stocks. So we deduct sundry creditors from total stocks because on unpaid stocks we will not finance. And on remaining paid stocks only, we deduct margin and allow limits. This is what drawing power we will allow. But this is normal case. But with the permission of GM, HOCAC, GM or CGM, HOCAC and above authorities, with their permission, we need not deduct sundry creditors up to accepted level for arriving drawing power. I will tell you example, 200 crores is total stocks. Sundry creditors is 60 crores. Sundry creditors is 60 crores. At the time of sanctioning loan, we have assessed working capital limits. At the time of sanctioning loan, 50 crores was sundry creditors. Sundry creditors. So what this, with the permission of CGM, HOCAC and above, we need not deduct sundry creditors up to 50 crores because up to 50 crores we have accepted at the time of sanction. So now out of 200 crore stocks, present sundry creditors 60 crores. Out of 60 crores, the entire 60 crores you need not deduct. 50 crores already you have accepted in the beginning. So 60 minus 50, only 10 crores. 10 crores only you deduct out of 200. And on 190, you calculate drawing power. This is what sundry creditors need not be deducted for arriving drawing power with the permission of CM, CGM, HOCAC and above. Right? Next, regarding term loans. The definition of term loans means any loan which is repayable in more than 1 year is called as term loan. Above 1 year up to 3 years, it is medium term loan. Above 3 years, if it is repayable, it is called long term loan. This is the definition of term loans. And while considering infrastructure proposals, mechanisms like escrow, creation of debt service reserve account, monitoring cash flows through trust and retention account, and appointment of lenders, independent engineers, etc. This you have to follow in infrastructure proposals. Escrow account. What is escrow account? Escrow account means for particular purpose we are opening this account. After completion of that purpose, account will be closed. This is what escrow account we call. Here I will tell you for understanding again, we will go for escrow account definition so that we will, yeah. What is this escrow account? Here, through example, there will be 4 parties for escrow account. I will tell you example. We have given loan to one corporate who has constructed power project. That is corporate. This corporate, it is selling power electricity to state electricity boards. That is their customer. So here, whatever payments are coming, whatever receipts are coming from that project, these receipts will be credited to escrow account. This escrow account will be maintained with one bank which is called as escrow agent. So here 4 parties are there. One is escrow agent bank, second one is our bank, financing bank, second one. Third one is our borrower. Fourth one is borrower's client, that is electricity board. Fourth one. So whatever payments are coming from electricity board, it will be credited to escrow account. And from escrow account, our repayments we will take. Remaining amount only we will allow to borrower for other purposes. This is the mechanism. So after completion of this project, complete whatever the tenure is there, after that account will be closed. Right? This is one. And second one, trust and retention account. Here only 3 parties. Trust and it is also similar, but here 3 parties only. Here one is banker. Suppose road project. For example, we will take road project. In road project, we are giving loan to a borrower for road construction of road. So bank we are lending, we are lender. Second one is our borrower. Second one. Third one is TRA agent. TRA agent may be our bank or some other bank. So here 3 people. What happens here? Our borrower who has constructed road, he will collect toll and he will credit to TRA account. From TRA account, we will take our installment, etc., etc. And remaining we will allow to the party. No checkbook facility, either escrow account or TRA account, no checkbook facility. Party cannot withdraw. Entire thing will go as per arrangement, TRA agreement or escrow agreement. As per this, it will go. So that what happens here, whatever income is generated from that project, either power project or rose project, whatever income is generated, that will be directly credited to banker, either TRA agent or escrow agent. Party is not having access. We will recover our money. Remaining money only we will release to the party for others. This is TRA. Second one. And next one, we will go for this. Escrow, TRA, debt service reserve account. Normally, in case of term loans, what happens is, we will ask the borrower, you create one debt service reserve account equal to 3 installments, 1 quarterly installment or 2 quarterly installments or 6 months installments like that. We ask. Why we ask this? Suppose any problem is there. 1 or 2 months there is no income for that, some problem or excess expenditure is there, income is not sufficient. In such cases, what we will do, we will take our installment from DSRE account, debt service reserve account. Mostly it will be kept in either running account or in term deposits also. So we will take from this account, and so that account will not become SMA or NPA. For this, we will ask the creation of debt service account. In case of infra term loans, big term loans, project loans, it will come. Right? Trust and retention account. Lenders independent engineers. Lenders independent engineers means in case of power project or road projects, etc., big projects, What we will do, we cannot go and see every time what is the progress going on, whether it is correct, rightly going or not, work is running or not, we don't know. So for that, what we will do, we will appoint one engineer on our behalf. He is called as lender's independent engineer. He will inspect and report to us periodically. And the next one, this escrow account and TRE account waterfall mechanism they will follow. That means whatever account amount is credited to either escrow account or TRE account, as per agreed sequence, it will debits will be there. Agreed sequence. What is that agreed sequence? First, operation and maintenance, because that project it has to maintain. For that operation and maintain, toll collection people, employees, salaries, etc., etc. Otherwise, it cannot run. Unit will not run. So employees O&M first we call operation and maintenance. Afterwards, any government dues. Next to bank dues, and afterwards any party. Like that, it is called as waterfall mechanism. So whatever credits are coming into TRE account or escrow account, how they have to be dispersed, how they have to be adjusted. It is called waterfall mechanism. Hybrid annuity model. This is another one. What is this again? Hybrid annuity model. Here, it comes in case of mostly road projects. Hybrid annuity model. What happens in road project? Earlier, what happened is government will give one person, yeah, government will give you contract. Yes, you go and complete one road, big national highway or some road, and collect toll for 30 years. And after 30 years, you hand over to us. This is what BOT we call built, operate, and transfer. For entire road, your expenditure you meet. So what we will do, we will finance the borrower. He will complete the road, and after completion of road, he will collect toll and pay to us. This is what BOT. And EPC, another one is there, engineering, procurement, and construction. Here, what in EPC? Only contractor will complete and hand over to government. Government will pay some amount, whatever the charges are there, whatever he has construction cost, for some profit, government will pay to him. This is EPC. And the hybrid means it is combination of both. What is here? Suppose 10,000 crores is project cost, road project cost. Out of 10,000 crores, 40% the government will give in 5 years. Out of 10,000, 40% is 4,000 crores. 4,000 crores in 5 years, every year, 800 crores, 800 crores like that, it will give to the borrower. So now borrower shortage is out of some 4,000 crores. See, 10 out of 10,000 crores, 4,000 crores is already government share, 6,000 crores is shortage. So 6,000 crores banks will finance. What happens after completion of that road? Toll will be collected by government only, and the government will pay to this construction person continuously in every half yearly some amount. This is called annuity. So first 5 years they will pay 60 to 40%. Remaining 15 or 20 years they will pay remaining 60% also, plus some additional amount. This is called hybrid annuity model. This is particularly famous in case of road projects. These are all term loans, project finance loans. So we go for next one. Tail risk, another one in project finance it will come. Tail risk. Tail risk means suppose for term loans you are fixing 20 years repayment. 20 years repayment. And economic life of that unit is 20 years only. Economic life of that unit is 20 years only. Normally, our guidelines are that even for housing loans also, what our guidelines, at least 5 years should be there after our repayment. Economic life of that asset, whatever you are financing, economic life of that asset should be at least 5 years after our repayment, completion of our repayment. That means if economic life of project is 25 years, then you fix the repayment up to 20 years only. This is what actual normally happens. But in what happens in term loans is initial period, sometimes they will ask, sir, initially we are not getting full income. So you reduce repayment initial period. For suppose repayment is 20 years. Every year they have to pay some 1,000 crores. 20 years, 20,000 crores they have to pay. What they say is the initial 4-5 years we are not getting sufficient income. So initial years we will pay only 500 crores only. This 500 crores we will pay in last installment. Like that, they will postpone. Initial period, they will pay lesser amount, and at last stages, they will pay more amount. Suppose if income is not sufficient in last period, they cannot pay. This is called a tail risk. Initial period, they will get more amount, so they have to pay more amount, more repayment. Last period, they may get lesser amount. So what guideline is 75% of loan should be repaid within first 75% of the period. That means if 20 years repayment is given, 75% of loan should be repaid within 15 years by leaving 25% of the period for last installments. It is called a tail period. Right? This is what tail risk normally we have to fix 25% generally we will prescribe in case of non-infra and 20% in case of infra. At the time of restructuring, 20% in case of non-infra and 15% in case of infrastructure projects we will fix. And tail period is not applicable for hybrid annuity model. Next, reimbursement of term loans. Normally, up to 25% it is permissible, term loans reimbursement. And by CO head and above authorities only, again, guidelines. And for eligible condition, low risk and normal risk borrowers, only for plant and machinery. Suppose party has incurred expenditure for purchasing plant and machinery, that only we will reimburse, not for land and building. And reimbursement party has to claim within 6 months from the date of incurring, from the date of purchase. Okay. Out of total loan, 25% only eligible for reimbursement to. And the next one, only for plant and machinery. Third one, within 6 months, they have to claim. Other general guidelines are there, like chartered accountant certificate to, plus your insurance, so stamped receipts. So these are all common guidelines you have to follow. Regarding project appraisal, this is also important in several. Already we have discussed it. For conducting, in case of project finance, compulsorily project appraisal is to be conducted. And cutoff limit is, in case of new borrowers, 10 crores and above. In case of new borrowers. In case of existing borrowers for expansion, modernization, etc. In that case, project cost 20 crores and above, you borrower dealing with us for 3 years or more and rated as low risk or normal risk. In our internal rating, CNR 1 to CNR 5, normal risk CNR 6. In the external rating, BBB or better rating. So 20 crores and above, it is compulsory for borrowers dealing with us more than 3 years or more. And 15 crores and above for borrowers dealing less than 3 years with us. And moderate risk, irrespective of dealings, 10 crores and above. That means I told you for new borrowers and moderate risk borrowers, 10 crores and above is cut off. For existing borrowers, 15 crores or 20 crores, basing on the risk rating and dealings with us. Right? In case of commercial real estate, already we have discussed all projects of commercial real estate, irrespective of proposed project cost, compulsorily this project appraisal is to be done. But CRE up to 5 crores, residential housing, it is exempted. You need not do. For agricultural term loans, AIC will do Agricultural Innovation Center, we call. Earlier, we used to call it as Agricultural Consultancy Services. At head office, it is there. Now it is Agricultural Innovation Center. They will do project appraisal of agricultural loans. For new customers, project cost above 400 lakhs. That means above 4 crores. For existing customers, project cost above 7.5 crores. This project appraisal is applicable. This is about conducting project appraisal. So validity of this PAG or PAC or PAV, whatever report they are giving project appraisal, it is valid for 6 months only. And after 6 months, it will be revalidated for another 6 months. But they have to pay charges for first project appraisal, they have to pay. And after 6 months for revalidation also, they have to pay 25% of applicable. Next. Irrespective of sanctioning authority, project appraisal cell at circle shall conduct appraisal. As I told you, at circle level, GM headed 100 crores, up to 100 crores they will do. DGM headed up to 50 crores they will do project appraisal. And next, bank may utilize the services of externally empaneled TEV consultant, not only our PAC or PAG, Apart from our PSC or PAG, even externally empaneled TEV consultants also, they will do this project appraisal. But earlier guideline was that up to 250 crores only they will do. That too, after submission, our PAG or PSC will vet that. Vetting also our people will do. PAG group. But now, current year, change is that this services of empaneled TEV consultants who are all there, their services may be utilized for more than 250 crores also. This is current year change. Earlier, till last year, TEV consultants up to 250 crores only we can engage. But now beyond 250 crores also, we can engage TEV consultants with the permission of CO head and above authorities. Right? This is current year modification on selective basis with due justifications. Next, approval of this project appraisal report by DGM, Circle Office DGM, or at Head Office GM. Next, annual review of term loans. Term loans sanctioned by Circle Head CSE and above authorities. Annual review should be there. Annual review. And standard restructured NPA not market recovery. These accounts are all eligible. All retail loans up to 5 crores exempted. Annual review. Olden days, simply they have given first 5 crores, they have given cut off, subsequently 1 crore they have reduced. Now they says TL loan sanctioned by Circle Head CSC and above. You have to do annual review of term loans. Suppose exclusive term loans, if you are given, then annually you have to do. Term loans along with working capital, it is given, then along with working capital renewal, this review also we have to do. Right. Financial benchmark parameters for all term loans. Financial benchmark parameters we have to compulsorily meet. Then only we can sanction. So these benchmark parameters for transport operators, debt equity ratio 3:1. I have given small table by mixing all for easy understanding. And for understanding, I will tell you instead of single one, broadly I will tell debt equity ratio generally 3:1 applicable. Debt equity ratio. Only in case of takeover 2:1 applicable. For SME 3:1 and 4:1 also accepted. So debt equity ratio generally 3:1 is applicable, but with the permission of next authorities, it can be up to 4:1 also. 4:1. So transport operators, it is 4:1 permissible up to 100 lakhs. That means up to 1 crore. Small loans, it is also permissible. Above 1 crore also, it is permissible. For agriculture also, it is 3:1. But 5.66:1 only for projects up to 10 lakhs, it is applicable. Right? For infra, 5.67 also, it is permissible. Debt equity ratio. What is debt equity ratio? Long-term debt divided by tangible net worth. That is debt equity ratio. That means for their net worth, tangible net worth means total net worth minus intangibles. So out of their net worth, how many times of their net worth they have taken outside borrowings? This is what leverage. Okay. Next, debt service coverage ratio. Blindly, you can remember it is 1.50 in general, almost all. 1.50 debt service coverage ratio. But it can be reduced in some cases. Big loans above 1 crore, it can be reduced to 1.40. And agriculture up to 1.25, infra also up to 1.25. So DSCR in general 1.50. Fixed assets coverage ratio in general 1.33. It can be reduced to 1.20 in case of genuine reasons. So FACR generally 1.33. It can be reduced to 1.20. Here 1.20 CO power for above 100 lakhs to 1.20 CO powers, 1.25 RO powers. For agriculture, 1.20 only. Infra up to 1.11 also accepted. This is FACR, fixed assets coverage ratio. What is this fixed assets coverage ratio? Total fixed assets divided by term loans. Right? Next, repayment. Of course, repayment it varies. Transport operators 6 years. Up to 100 lakhs, it is 7 years. Above 100 lakhs, 7 to 10 years. With moratorium, it is 12 years. Agriculture, 5 to 7 years. 12 years in case of 15 years in case of plantation. Infra normally 15 years can be extended for 20 years also. This is repayment. Next, margin. Margin. Small loans 20%, PC up to 100 and above 100 also it is 20%. Agriculture minimum 15% because we call it as 15-25% margin in agriculture. And infra normally 15%, it can be reduced to 10% also. For hybrid annuity model, it is 10%. This is about margin. And internal rate of return, IRR, it is applicable for project cost 25 crores and above. This is applicability. Internal rate of return applicable for project cost 25 crores and above. And in case of above 100 lakhs loans, in general for IRR, it is 4% above weighted average cost of funds. In general, IRR rate should be 4% above weighted average cost of funds. It is equation for this. But exception only in case of infra, road projects, up to 2%. 2% above weighted average cost of funds, we will accept. So these are financial benchmark parameters. Mostly they are touching one point in exam. That's why I have given, easy to remember also. Next, FACR, fixed assets coverage ratio. It can be reduced to 1.25 CO level, 1.20 also it can be accepted. Okay. Next, interest during construction, we call it as IDC. Interest during construction, generally it is part of project. Total project cost is there. Out of project cost, interest during construction is also one of the parts. It will be included, but we should not finance. Though it is a project cost, we should not finance. IDC should be part of margin, right? Next, minimum equity contribution by promoter shall be 50% of overall margin. Normally, any term loan, big project loans, what happens is we will prescribe normally 25% margin. We will prescribe. Out of 25% margin, owner's equity, that is what promoters, minimum equity contribution by promoters, it should be minimum 50% of overall margin. For example, I will tell you 100 crores is your total project cost. 100 crores is project cost. Out of that, margin is 25 crores. Margin is 25 crores. So out of 25 crores margin, 50% minimum own money. That means 12.5 crores should be owner own money. That is what? Equity contribution by promoter. And what about the remaining 12.5 crores? It will be subordinated debt. It permissible. Total 25 crores if party brings, well and good. But minimum he should bring half of that. That means 12.5 crores in our example. So minimum equity contribution by promoter shall be 50% of overall margin for total project. Next, current year change and important for current year exam. For infrastructure projects, minimum equity contribution of promoters out of total margin basing on ECAI rating. Same example, if you take here, 25% is total margin. Out of 25%, at least half they have to bring. That is what we told you. Half. But half means 50%. But if good rating parties, AAA rated parties, instead of 50%, you can reduce to 25% only own money. That means remaining 75% quasi outside borrowings. If it is a AA rated, 30% only. If it is a single A rated, 35%. So LR1, LR2, LR3, 35%. And others 50%. This is a common guideline. So for good rated corporates, common equity also can be less. Half of required amount. Right? Suppose new party rating is not available. New party rating is not available. In such cases, what we can do, their sponsor rating also you can take. For ECL, because AAA, AA, we are telling enough. For new units, there will not be rating. You just now started. In such cases, their sponsor rating you can take. And accounts covered by central state governments, minimum equity 25%. Right? Remaining share of promoters' contribution shall be in the form of equity or quasi-equity. So this is one of the important points for current year exam because it changed, latest change. And treatment of quasi-equity for term loan, 50 crores and above. Maximum cap on quasi-equity shall be equal to 100% of equity. Same norm here. Quasi-equity should be 100% of equity. That means out of total margin, whatever you are prescribing, own money 50%, quasi-equity 50%. Permissible, general. So quasi-equity is equal to 100% of own equity. So quasi-equity shall be to the extent of 100% of own equity. Right? If quasi-equity is withdrawn, 1% additional interest we have to charge. Right? And for financing stressed sectors identified by bank, 100% collateral is required. Okay. Okay, delegation of powers for gem and jewelry. Current year change, it is important. Only this point I will go through. Moderate risk rated accounts and above 5 crores accounts, including new borrowers, sanctioning authorities, ED, CAC, and above. This is the latest change, current year change. Okay. For discoms, that is the electricity board discoms, working capital shall be 25% of total revenue as per audited balance sheet. This is 25%. Normally, 20% will fix turnover method we have seen. So here up to 25% it is permissible. In case of Genco and Transco, up to 50% of total revenue also permitted. Right? Next, regarding takeover of borrowing accounts. Takeover of borrowing accounts. Suppose party has closed with other banks and coming to us after 3 months. Then takeover norms you need not apply. Party is closing and coming to us after 3 months. In case of agriculture and retail loans, party is closing with other banks and coming to us after 10 days only. Then these takeover norms will not be applicable. Okay. Next, takeover policy for exposure up to 100 crores. Okay. What are the general guidelines of this takeover policy? First one is account should be rated as BBB and above. And in case of MSME, BB and above. Triple B means it is normal risk. BB means moderate risk. So other than SME, normal risk up to normal risk permitted. For MSME, moderate risk also permitted. Even as per our policy also, moderate risk and above are considered as investment grades. So we can sanction up to moderate risk only. High risk category normally at head office level, CAC and above authorities only will sanction for new loans. Okay, this is the guideline. So for takeover, BBB in case of other loans and SMA, BB. Earning operating profit for 3 years. That is another condition. And next one, previous 1 year, it has not restructured. And there is no downgradation of external rating. Not appeared in SMA2 during last 18 months as per CRILC report or CA report. This is also important now. Previous 18 months not appeared in SMA2. And the next one, the account should have been in the books of transfer bank for minimum 1 year. Other bank, at least it should have been minimum 1 year. 6 months for low risk and A and above rated borrowers. So this 1 year can be reduced to 6 months. That means with other banks, A rated accounts, you can take after 6 months, no issue. And in case of manufacturing units, it should be minimum 1 year old manufacturing. And they should have been satisfactory repayment track record for 6 months and DGCO at least more than 6 months back. Date of commencement of commercial operations, more than 6 months ago it happened. That means repayments, more than 6 repayments will be there because repayment will start after date of commencement, immediately after date of commencement of commercial operations. So more than 6 months ago, DCCO happened. That means more 6 repayment installments are there. Right? Next. Yeah. Yes. Next one. Shifting of accounts from other banks, not more than one occasion during last 5 years. And the gap to last switchover shall be minimum 1 year. So in previous 5 years, there should not be more than one shifting. And from previous shifting, minimum 1 year gap should be there. And 2 years for above 100 lakhs loans. It is exempted for, again, good rated account. It is exempted. And the parties who were earlier with us and gone to other banks, now again they are coming. In such case also, you need not see 1 year or 2 years now. But good rated people, 6 months is sufficient. Okay. That means previous shifting, at least 6 months I to be chalega in case of good rated people. So general guideline, minimum 1 year gap should be there, 2 years in case of big parties. It is exempted those borrowers who were earlier with us and gone to some other bank, maybe for pricing, etc. reason. Again, they are coming to us. In such case, you need not see this 2 year norm or 1 year norm. Next, audited financial statements of previous 3 years. You have to obtain and verified with the ROC. This condition already we have discussed. We have to verify it the Register of Companies website. Previous 3 years audited statement and current ratio 1.33 and 1.25 for turnover method. So normal whatever applicable ratio they have to meet. For MSME, current ratio relaxed up to 1, including 1. Only in case of MSE, you can consider up to 1 current ratio. Debt equity ratio generally not more than 2:1. We have seen our policy 3:1. So it comes under relaxations. Relaxation 3:1 also you can proceed for takeover. For MSME, debt equity ratio 3:1. And pass it for 1 year in case of term loans or 6 months in case of working capital, you have to take and verify. For term loans, if time overrun or cost overrun is more than 15%, no takeover. Cost overrun, project cost they says 100 crores, but now it has become 120 or 125 crores. Cost overrun is more than 15%, no takeover. Time overrun, they says within 2 years, DCC commencement of commercial operations will start. DCCO, they will complete, they will attain DCCO and repayment will start after 2 years. But 2.5 years over DCCO, that means 25% more. Then it is time overrun. It is not permissible. Up to 15% overrun only, it is permissible. Right? Dilution of security or reduction in margin should not occur. While taking over, margin you should not reduce. Similarly, security also, no dilution. No, another one, repayment period not beyond original repayment. Whatever leftover repayment with other bank, same repayment we have to give. We should not extend. Only for one case, that is leased rent discounting. This is under our retail lending, LRD proposals. There we can extend up to maximum 180 months. Under scheme, 180 months is permissible. So beyond leftover period with other banks, within maximum 180 months total period, we can extend. Next, for takeover with enhancement, security coverage in the form of land and building, our own bank deposits, NSE, KVP, etc., not less than 50% of entire exposure, including enhancement amount. So minimum security coverage should be minimum 50%. And out of that again, vacant land not more than 50% of total collateral security. This is another norm while taking over. Security should be at least 50% and vacant land not more than 50% of total security. Next, if enhancement is more than 25%, then sanctioned by next higher authority. For HO power account, same authority. Next, if fresh term loans are proposed, expansion during takeover, respective sanctioning authority, etc. Okay. And enhancement and also concession, both next to higher authority. Next, proposal with enhancement, collateral is more than 100% of the exposure, including enhancement. In that, at least 15% of collateral should be minimum commercial or residential. Proposal with enhancement, if you are considering at the time of takeover, if collateral is more than 100% is available, in such cases, at least 15% should be commercial or residential properties. Next one, stock audit, it is compulsory for takeover accounts in the time of taking over stock audits. But stock audit is waived. Two conditions here. One is up to 10 crore. When waiver will come, provided previous bank's stock audit report not older than 6 months. Previous bank stock audit report, if it is not older than 6 months, you take that report and take 3 months again stock statements, then we can waive. Suppose if more than 6 months, the previous bank is having stock audit report of more than 6 months, in such cases, we can waive stock audit up to 3 crores limit only. If more than 3 crores total takeover means no question of waiver beyond 6 months stock statement, stock audit. Okay. Next, in case of MSME up to 1 crore, CO head may permit waiver of stock audit provided 125% collateral is there. So up to 1 crore, CO can waive provided 125% collateral security is available. So these are stock audit norms in case of takeover. Sanction communication of last 3 years. We have to verify. Agriculture, in case of agriculture, 1 year is sufficient. Sanction. Next, takeover from bank where any of our whole-time director worked earlier, sanctioned by GM, HO, CAC and above. For retail loans, here only, minimum 1 year prompt repayment, number 1. Number 2, CRG 3, up to moderate risk, you can consider. Okay, 1 year prompt repayment and CRG 3, 2 points, and not appeared in SMA 2 during last 18 months. This is also on par with the general. Next, loans where projects are not completed or not fully disbursed. That also not eligible for takeover, not completed. And similarly, period of extension, only lease discount we have seen. valid EMT should be created within 30 days of clearance of dues with other bank. These are retail loans takeover norms. Next, fresh facilities to OTS borrowers. One-time settlement, where we have done in such cases, OTS, it's a minimum cooling period is there. Suppose we have closed loan through OTS. So immediately we are not supposed to sanction. There is a cooling period. After cooling period only we can sanction. So what is this cooling period? It is basing on sacrifice amount as percentage of book liability. Out of book liability, how much we have written up. That is what our sacrifice amount. So up to 10% sacrifice amount means 24 months cooling period. After 24 months only we can sanction fresh loans. And above 10% up to 25%, I thought it is 36 months cooling period. Above 25% sacrifice amount is there. Then 60 months is cooling period. After 60 months only you can sanction. Gold loans other than agriculture, cooling period is 24 months. For gold loans also, other than agriculture, it is 24 months. Agricultural gold loans, 3 months. After 3 months, you can sanction up to 1 lakh rupee. Next, return of amount up to 10,000. Ignore after 24 months cooling period. If return of amount is there up to 10,000 rupees, you ignore after 24 months cooling period. And for non-willful defaulters and agriculture and allied activities, weaker sections up to 50,000 need-based finance after 3 months of closure of account, provided if they repaid at least 10% of previous loan amount. After 6 months, GLs as per delegation of powers for agriculture. After 3 months, 1 lakh you can sanction. After 6 months, as per delegation of powers, you can sanction agricultural gold loans. Restrictions of lending. No loans against our own shares. That is one. Second one, holding shares in the company. Section 19.2. This is several times it has appeared in exam. Section 19.2 of banking regulation is what it says. We should not accept shares of any company exceeding 30% of that share capital of that company or 30% of our own paid up share capital and reserves, whichever is less. That means more than 30% of capital of that company we should not accept as security. And similarly, it should not exceed 30% of our paid up share capital also. This is section 19, subsection 2 of Banking Regulation Act, 30% now. Section 19.3, okay, whenever our people they have worked, we should not take over. That is another one. Selective credit control. SCC, selective credit control means essential commodities, if you lend liberally, people will keep in godowns and create outside scarcity. To avoid that selective credit control, it has come into existence. Reserve Bank of India has implemented this. That means don't lend liberally to essential commodities so that they will keep in godowns. That is what. Then what comes? So many items were there earlier. Now only sugar only it is there. Earlier oils, cotton they were there. Now removed all. Only sugars are there now in SEC commodities. Remaining all removed. So in case of advances against levy sugar, minimum margin of 10% will apply. So to control our liberal finance, what we'll do is through selective credit control, RBI, it will increase the margin on against loans. So particular commodity loans, you increase margin. Against cotton, you increase margin. Or against oils, you increase margin. Like that, Reserve Bank will tell. So that parties may not buy more and keep in godowns. Next, no loans against term deposits of other banks. And similarly, banks are not allowed to grant loans against certificate of deposits unless specifically permitted by RBI. And no loans against party paid shares. These are restrictions. Similarly, for partnership or companies, etc., no loans against primary security of shares. Already we have discussed this. Only for individuals we will sanction against primary security of shares. That too up to maximum 20 lakhs only. That norm also will come. Okay. Next, banks, we are not supposed to grant any advance for purchase of gold. Similarly, at the time of sanctioning gold loans also, we should not finance against billion biscuits, etc. We should not accept. Coins also, maximum 50 grams sold by banks, we can accept as security. Remaining all should be ornaments, gold ornaments only. Next, no loans against gold exchange traded funds, ETFs, or gold mutual funds, no loans. Next, for government also for construction of own buildings, we should not sanction loans. Next, it is the environmental protection, ozone depleting substances, no loans, KVP. Next, bridge loans. What are bridge loans? Bridge loans are nothing but we are sanctioning loans against expected incentives or expected inflows, cash inflows. For example, I will tell you, party may ask loans against, they are going for issuing shares issue. So within 1 year, they may receive amount. Against that issue, they are expecting some capital amount. Against that, we can sanction loan. That is called bridge loans. But here restriction is no bridge loan against expected receivables from government in the form of subsidies or incentives. Now, so many loans are there where they are eligible for subsidy, etc. So against such expected subsidies, we should not sanction loans. This is what no bridge loans against amount receivable from central or state government by way of subsidies, refunds, reimbursements, etc. No loans against IDRs, Indian Depository Receipts. What are these IDRs? Some foreign company, they have issued shares in abroad and they want to enter into Indian market. They cannot enter directly. So they keep with some depository, Indian depository. That depository will issue certificates. That certificate will represent shares of foreign company. So against, they are called as IDRs, Indian Depository Receipts. Against IDRs, we will not sanction loans. Of course, major variations. As per our policy, we have given security should be this much, margin should be this much, repayment, etc., etc. So these are all main guidelines. Out of this, you are giving any loan with some variation. That current ratio, I told you, current ratio should be 1.33. New party has come. Current ratio is 1 only, not 1.33. So that is variation. Such a variation, so margin should be 30%, but party asking for 20%. That is another variation. So such variations normally we should not sanction loans. It will be next to higher authority. GMHO CAC may permit maximum 2 variations. ED CAC maximum 4 variations. Beyond 4, MC on the board. Right? Credit delivery, it is only time norms, unnecessary time waste only. Only figures are there, you can go through so that we will go for other topics. Credit delivery, only time norms. Within how many days application is to be disposed of? Yeah. General matters, commitment charges. What is this commitment charge? We are sanctioning loan to borrower. Borrower is not availing that loan. Simply, only part. Earlier example, we have seen LSDBC. Only portion they are availing, remaining they are not availing. In such cases, what happens? We are losing by way of your capital because Reserve Bank says Unavailed portion, you convert as a fund based with a conversion factor 20%, and on that you maintain capital. So to protect from that, what we will do, we charge commitment charges to borrowers. This is what commitment charge on committed lives. We have given commitment, yes, this is your sanction, but party is not availing. So not availed portion we will charge. This applicability is corporate borrowers enjoying fund-based, non-fund-based combination 10 crores and above. 10 crores and above, if they are enjoying limits, for them it is applicable. And what are the charges? It will be levied on unutilized or unavailed sanctioned limit only. On that it will be. Suppose if average utilization during the quarter is more than 75%, in case of working capital loans, average utilization during that quarter is more than 75%, no penal charges. If average utilization during any quarter is between 50 to 75%, then 0.5% per annum, we will charge additional interest. This is what commitment charge. And it will be recovered on the entire unutilized portion on quarterly basis. If average utilization during the quarter is less than 50%, then 1% is commitment charges. Okay. Next, peak and non-peak limits are fixed. In such case, if utilization is less than 75%, then also 1% we will charge commitment charges. In case of term loan, what happens in term loans? Working capital, of course, we say this is the limit they have to avail. But term loans, what happens is drawdown will be there because at a time they will not take term loans. When construction progress is going on, they will be go on availing term loans. Okay. So here, how we will charge the term loans? First disbursement as per sanction does not take place within 3 months from the date of first scheduled drawdown. This is first drawdown is from September, so and so date. They have not availed up to December. They have not availed. Then we will charge 1%. We will charge on unavailed portion, that whatever the first drawdown amount is there on that amount only, not on the entire liability. Say first installment of disbursement may be 10 lakhs. On 10 lakhs only we will charge for that quarter, not entire period again. Okay. Next, regarding penal charges, recent circular also, policy also, they have got penal charges following. Penal interest for delayed payments. For delayed payments, suppose overdue. In that case, what is the penal charges? Priority sector above 25,000 up to 2 lakhs, 1% per annum we will charge. Above 2 lakhs, 2% per annum penal charges. But it is not applicable for government sponsored schemes. RO head CSE, they are having powers to waive in case of genuine reasons like natural calamities. And 1% penal charges in case of cooperative societies, FSS and labs. Okay, education loans up to 2 lakhs, no penal. Beyond 2 lakhs, 2% per annum for overdues. Penal charges. Non-priority above 5,000, 2% penalty. TOD 2% per annum beyond 15 days. Because TOD normally we will permit for 15 days. For 15 days, we will charge a clean rate of interest. If it is not cleared within 15 days, then 2% extra we will charge. And a delayed non-submission of stocks, MSOD or book debt statement. Monthly stock statement or quarterly stock statement they have to submit. If there is a delay, then 2% per annum on the entire liability of the party for the delayed period, we will. And the refund, if they ask in case within 3 months, the respective sanctioning authority, they can give refund. And that is also above RO head. Beyond 3 months, it is GM, HO, CSE. Next, QoS and HOS, quarterly operating system and half-yearly operating system. This is applicable for fund-based and non-fund-based exposure of 5 crores and above. What is quarterly operating system? Party has to submit this quarterly operating system. And the due date for submission is 6 weeks from end of quarter. That is quarterly operating system. That is what their cash flows, etc. they will mention. Half-yearly operating system, their financials for half-yearly, they have to give. And due date is 8 weeks from end of quarter, half year. QoS 6 weeks from end of quarter. HOS 8 weeks from end of quarter. If they are not submitting within that period, First one, it is applicable for fund-based and non-fund-based exposure of 5 crores and above applicability. And what are the penalty for non-submission? 1% on the fund-based liability, 0.25% on the non-fund-based liability, but non-fund-based liability exclusive cap is 1 lakh rupees only. Maximum we can charge penalty. Where party is enjoying both fund-based and non-fund-based. In such cases, 1% penalty on fund-based liability and 0.25% penalty on non-fund-based liability with no maximum, like 1 lakh here. No maximum. Next, waiver up to CO powers next higher authority above RO head, HO power accounts EDCAC. This is for waiver. Next, drawings in excess of sanctioned limits. Sometimes we will be permitting in excess of drawing limits, sanctioned limits. In such cases, 2% per annum on the overdrawn portion till account is regularized. Even ad hoc also, if you are sanctioning, that is what drawing beyond sanction. In such case also, it will applicable. 2%. For export, it is not applicable. For others, it is applicable. Okay. Drawings in excess of drawing power. Drawing power. Beyond drawing power, if you are permitting drawings means it comes under clean loan because no security is there. Then it will become clean loan. In such cases, 7% per annum penalty over overdone portion till the account is regularized. And no waiver permissible in this case. Devolved liabilities. BGs or LCs devolved. In such cases, 2% penalty from the date of devolvement till its regularization. No waiver is permissible. 2% beyond applicable rates. That's what. Next, demand bills. 2% per annum from 8th day till realization. Demand bills, they have to pay within 7 days. So 8th day onwards, 2% penalty applicable. Nuisance bills, they should be paid on due date. So there, if they're not paying, then 2% per annum from due date till realization or clearance. Diversion of funds. Suppose if they need diversion from business they have taken over outside, they purchased personal items instead of business. So such cases diversion, then 5% on entire liability from the date of such diversion till it is replenished. Till they get back that amount into the business, we have to charge 5% in case of diversion. For delay in creation of EMT or second charge, normally at the time of sanction, we will give so and so time you have to create charge, either EMT or second charge. If there is a delay, 1% per annum on outstanding liability, we have to charge. Waiver by CO head up to 1 year delay, beyond 1 year GMHO. In case of stalled projects, 2% penalty till creation of EMT. Stalled projects. Say housing loan you have given big project, it is stalled. There also till EMT you have to collect 2% penalty. Annual financial statements. Earlier we have discussed this. 31st October, 7 months from close of financial year, they have to submit, otherwise 2% penalty from 1st November onwards. Next, penalty for non-compliance of bill culture norms. So certain percentage of the turnover should be through bills. This is what at the time of sanctioning working capital limits, it is fixed. So if they are not following bill culture norms, 2% per annum penalty. Next, charges for handling discrepant documents received under LC. Normally, any discrepancy in the documents received under LC, within 5 days, we have to inform. But still, we will be dealing with the documents. In such cases, 0.25% of the bill amount with minimum 1,000 rupees and maximum 5,000 rupees per bill plus GST we have to collect for handling discrepant documents. Penal charges for non-submission of renewal papers before 1 month of expiry date. Because normally working capital limits are permitted for 1 year period, 12 months period. So immediately after 11 months, they have to submit these renewal papers. That is 1 month before expiry date. If they are not submitting, then we have to collect a penalty. What is the amount? Above 10 lakh limits, above 10 lakhs up to 10 crores, flat 5,000 rupees up to the due date of renewal, and flat 10,000 rupees per month thereafter till submission of renewal papers. If limits beyond 10 crores, flat 25,000 rupees up to due date of renewal, and flat 50,000 plus GST thereafter till submission of renewal papers. GMHO CSC up to 50% waiver, ED and above full waiver. Covers. Next, penalty for non-construction of house, including HLCRE. This is 2% penalty from the date of sanction till start of construction on the outstanding liability. Waiver is not possible. Penalty for account slipping to NPA. Account has become NPA, then 2% penalty on outstanding we will apply. Penal charges for prepayment of credit facilities, working capital and term loans for prepayment. For takeover by other banks only, party is clearing out of own funds, no penalty. If loan is taken over by other banks or financial institutions, then term loans 2% of outstanding liability. In case of working capital facilities, fund-based 2% and non-fund-based 0.5% of sanction limits. This is the penalty. All MSCs, no penalty. Next, current year change effective from 1/1/2026 for all working capital and term loans of individuals and MSCs. No prepayment charges for all floating rate loans and advances of individuals other than for business purpose and also for business purpose and MSCs. So here, working capital and term loans to individuals or SMEs, floating rate loans, no prepayment penalty. Next, another one, for non-submission of statement of unhedged foreign currency exposure, quarterly signed by borrower. Normally, unhedged foreign currency exposure, any of our borrower is having foreign currency exposure. That means commitment. They may be importing some machinery and they have to pay after half year or 1 year like that. Or they may be importing something, they have to pay in foreign currency. That is what foreign currency exposure. Any such commitment, party has to give us statement. That is quarterly statement signed by borrower, it is sufficient. And yearly statement should be signed by auditor. What is foreign currency exposure? Which is unhedged. Here unhedged means normally any foreign currency exposure, they will book through forward contract. It is called hedging. Suppose after 6 months, the party has to pay $1 lakh. Commitment is there after 6 months. So for 6 months, the party will enter into forward contract for $1 lakh. Whatever commitment is there, they will enter into forward contract and to pay that premium towards contract. That is hedged, we call. If he is not booking forward contracts, or if he is not receiving any inward remittance also, like export receivables, then it is called as unhedged foreign currency exposure. $1 lakh he has to pay, not covered and no inward remittance. So it is called as unhedged foreign currency exposure. That statement party has to submit quarterly, signed by him, and yearly it should be signed by auditor. Right? Next, enabling mechanism for meeting payment obligations in case of corporates to MSMEs. This enabling mechanism means in MSMED Act, in 2006, the MSMED Act has come. At that time, in that Act itself, it is mentioned. Wherever banks are sanctioning loans to corporates, working capital limits 10 crores and above, they have to fix separate sub-limits towards repayment to MSCs. That means big corporates may be taking raw material from small MSCs. If big corporates doesn't repay to the small MSCs within time, the small MSCs will die due to starvation of working capital. So to avoid that, what this MSMED Act told is, MSMED Act, to prevent that, what MSMED Act told is, Whenever working capital limits 10 crores and above, you are sanctioning to corporates, you fix a sublimit towards repayment to small SMEs. This is what called as enabling mechanism. Next, duration of working capital 12 months, it is already fixed. We have already discussed this. And the review and extension of credit limits. Review and extension. Other than high risk customers, earlier we have seen party has to submit renewal papers 1 month before expiry. If it is not submitted, what we have to do? We have to extend the tenability. We have to extend the tenability. In case of other than high risk accounts, tenability can be extended by maximum 6 months, but 3 months at a time. 3 months at a time. First extension 3 months is given. Second extension 3 months, no concessions. And second extension is treated as fresh sanction. It is subjected to review by next higher authorities also. Right? This is second extension. So other than high risk accounts, 2 extensions we can do, maximum 6 months period. And high risk people, high risk borrowers, only 1 extension, that too for a period of 2 months only. Right? Next, validity of sanctions and revalidation. Loan, working capital we are sanctioning, it is valid for 3 months. If they are not availing within 3 months, it can be revalidated by another 3 months, same period. Afterwards, it will be expired and fresh sanction should be done. STCLs are corporate loan. Clean loan 1 month validity, secured loan 3 months validity, STCLs. Term loans 6 months validity. Again, it will be revalidated by another 6 months. Similarly, ad hoc facility valid for 15 days. Thereafter, no revalidation. And credit facility is sanctioned under consortium lending arrangement, consortium lending arrangements, where our bank is a leader or member. Then up to 6 months tenability we will fix. And validity period of sanction of working capital to or term loan to NBFCs. Whether you are sanctioning either working capital or term loan to NBFC, their validity period is 3 months. Sanction validity 3 months only. So revalidation also same period we can do. Ad hoc facility, no revalidation. Next, in case of consortium or JLA, they have already executed documentation, but within 12 months from execution of documentation, if they have not availed from any bank. In such cases, that also should be revalidated. Sanction should be revalidated by sanctioning authority. Next, normally consortium accounts, by keeping financial closure. Again, what is this financial closure? Financial closure means in case of project loans, 90% of their requirements, they are tied up, either own money or with the banks or financiers, they have tied up into 90% of sanctions are in hand. Then we call it as financial closure. So at the time of financial closure, normally they give 6 months time for sanction. But financial closure is delayed. Then the sanction, another 6 months it can be extended. This is in case of consortium. First 6 months, then another 6 months. Okay. Review come holding on operations. This review come holding on operations is just nothing but just like extension of tenability. But here what happens is standard asset or NPA accounts not marked for recovery. Normally, any problems are there in the account, genuine problems. In such cases only we will permit holding on operations. Account is already under stress. If you stop operations, the unit will die. But it is genuine problem. So in such cases, we will extend tenability. It is called as review come holding on operations. So here also same period, 6 months we can do maximum and 3 months at a time. So here review come holding operations once can be permitted for maximum period of 6 months only and 3 months at a time. And the current year change, important one is that sanctioning authority, while permitting holding on operations in respect of accounts considered for rehabilitation or restructuring, they shall stipulate a minimum cutback amount of 1% of the amount realized in sales for reduction of irregularity. So whatever they are receiving credits, sale proceeds, out of that 1% is cut back amount. That means that will be adjusted to overdues 1% continuously. This is latest addition current year. Okay. Next, rejection of credit proposals. Rejection of credit proposals. Applications of SC/ST beneficiaries, number one. Number two, applications received through Janasamarth portal. Number one, SC/ST beneficiaries. Number two, applications received through Janasamarth portal. These two branches cannot reject. They should be rejected by next higher authority. Next higher authority. That means it has to be forwarded to next higher authority. They will reject. Next, educational loans, MSME. These two, concurrence of next higher authority. Branches can reject, but with concurrence of next higher authority. Government sponsored schemes, branches can reject, but record in the register so that reviewing authorities, they will, executives during their visit to branches, they will review. Export credits, branches can reject, but report to MD and CEO through concerned wing. These are proposals, rejection of proposals. But any proposal, we have to record in NB 139, that is branch sanction rejection register. And this register will be reviewed by higher ups, controlling authorities during their visit to the branches. Right? Next, conversion of limits. Conversion from fund based to non-fund based or non-fund based to fund based. This is what conversion. But non-fund based limits, only letter of credit and advance payment guarantee. That is also for purchase of raw materials. They can be converted into fund based limits, not others. Only LC and APG for purchase of raw materials, they can be converted to fund-based limits. Similarly, fund-based limits may be converted to non-fund-based limits. That means any OD, OCC like that fund-based limits, they can be converted to non-fund-based limits, BG, LC like that, or term loans, DPG, like that they can be converted. But for purchase of stocks only, term loans not eligible, and OD, OCC, etc. They can be converted to non-fund based limits, but that too for purchasing stocks only. Next, post shipment to pre-shipment is not permitted. Post shipment means bill financing, bills discounting. To pre-shipment means packing credit, running account, just like OCC. So bills to OCC not permitted, but OCC to bills it is permitted. PC to bills and not otherwise. Secured limits are not to be converted into clean limits. That means you are losing security, so not permitted. One-way conversion of limits from LC to BG for purchase of raw materials may be permitted to beneficiaries such as public sector undertakings, SAL, NSIC, and corporates rated as AAA or AA. For good people, for good corporates, we can convert to LC to BG. But conversion is only for procuring raw material. This we have to keep in mind. Exit policy, that means if borrowers' dealings are not good, we will try to send out the party. This is called as exit policy. Sending out means we will give you NOC, go and approach some other finance institution and get out of our bank. This is what called exit policy. Here, when we will go for this exit policy, persisting irregularities, defaults in payment of interest, installments, etc. So persistent irregularities, frequent ad hoc, no stock, and failure of restructuring or rehabilitation efforts more than twice in a period of 3 years. And borrowers rated as high risk, willful defaults, and unit has become uneconomical, promoters financial indiscipline, and steep downgradation in risk rating, that is not less than 2 notches fall. These are all exit policy. Suppose these are all parameters for exit policy. No go rated borrowers. Then we says Baba Jada ho gaya. Yes, you may go and approach some other bank. Then personal guarantee of directors when you have to obtain. In case of private limited companies, LLPs registers compulsory personal guarantee. And all loans 5 crores and above, Aadhaar number of applicant, co-applicant and guarantor, they shall be obtained and updated in CBS after due verification. And similarly, exposure exceeding 5 crores, CA certified net worth statement with UIN number certifying the net worth of the guarantor shall be invariably. Suppose whenever we have taken guarantor for our limits 5 crores and above, in such cases, we have to every year we have to obtain CA certified net worth statements of the guarantor. In this statement, UIN number of chartered accountant also should be there. UIN number given by the chartered accountant should be there so that we can verify through portal of ICAI. In respect of exposure exceeding 5 crores, half-yearly confirmation from the guarantors stating that the assets declared for arriving at net worth at the time of original sanction, they are still intact under his or her ownership. So here, exposures exceeding 5 crores, half-yearly confirmation from guarantors, whatever securities guarantor has given at the time of loans, first disbursement or first sanction of the loan, those securities are still intact and not dealt otherwise. That is what we have to obtain confirmation from guarantor half yearly. So yearly certified by chartered accountant, half yearly by guarantor himself, he has to submit letter. Next, promoters, they can give maximum 5 times guarantee for the associates or sister concerns, etc. Next, as I told you, unhedged foreign currency already earlier. What is unhedged foreign currency? I told you. And yearly they have to submit chartered accountant certificate. If they are not submitting, 1% penalty we will apply. Right. Next, incremental provisioning and capital requirements. This is also another issue in case of unhedged foreign currency. Suppose if they are not hedging foreign currency exposure, then what happens is Reserve Bank says you enhance number one provisioning, number two risk weight. So maximum risk weight up to 75% maximum risk weight will be enhanced. And second one, provisioning also. Provisioning maximum up to 0.4% provisioning also, it will be enhanced in case of unhedged foreign currency exposure. In such cases, what we will do, we have to charge additional rate of interest. And what is this maximum additional rate of interest? In case of additional risk weight, we can charge up to 0.4%, maximum 0.4% additional interest we will charge on fund-based and non-fund-based limits. In case of provisioning, first one is risk weight, second one is provisioning. If RBI says you have to enhance provisioning in case of so-and-so parties, in such cases, 0.14% to 0.2%, we will charge additional rate of interest. These two. One is, this is current year addition and important for current year exam, because I have not given in this one, but it is mentioned in my PDF file, which I have sent already. So for additional interest in case of unhedged foreign currency exposure, as Reserve Bank of India will say, you enhance provision or you enhance risk weight. If provision is enhanced, we charge additional interest 0.14% to 0.2% basing on provision. If risk weight is enhanced, maximum risk weight 75% enhancement will be there. For that, 0.4% additional interest we will charge. This is regarding unhedged foreign currency exposure current year change. Right. Legal audit of title deeds. It is part of RBIA we can do with credit exposures 5 crores and above, legal audit of title deeds, and every 3 years. First time after 3 years from the date of your loan documentation, and after 3 years we have to do, preferably coinciding with RBIA. Sometimes what happens is RBIA may be for 18 months. So in such cases, next legal audit may go 3 times enough. 18 into 3, 54 months. After 54 months also, gap will be there. This is about legal audit. Every 3 years to be coinciding with RBIA, we have to do. And cut-off limit is 5 crores and above. This is legal audit. Next, current year one change is there. While permitting sanctioning additional exposure up to 2 crores, including proposed exposure to the borrowers against existing mortgage. Suppose party has already mortgaged some properties. Against that property, you are giving additional exposure up to 2 crores. In such cases, you should obtain supplemental LSR from the advocate, not from earlier one who has given LSR. From other advocate, you have to obtain supplemental LSR. Right? Next, opening of cash credit or overdraft facilities. Normally, ODOCC facility whom you have to permit. Suppose if party is enjoying less than 5 crores from entire banking system, in such cases, we can allow opening ODOCC. But if party is enjoying more than 5 crores, in such cases, wherever the party is enjoying limits 10% of the exposure, say party is having 50 crores total exposure, 10% means 5 crores. In which bank he is having 5 crores exposure? In that bank only he has to open ODOCC. And beyond this, if any other bank opens ODOCC, it is only for credits. All debits should go to their pooling account where they are having this more than 10% exposure. This is guideline regarding opening of current account. External credit rating. So current year important one is earlier above 25 crores we have to go for external credit rating compulsorily. And this year it is enhanced to 50 crores. So above 50 crores, the external credit rating is compulsory. Even for risk, pricing of loans also. Pricing of loans above 50 crores grid methodology. Pricing of loans above 50 crores grid methodology. But in my, I think, PDF file, I have mentioned 25 crores only. Please correct that to above 50 crores. Pricing of credit above 50 crores grid methodology, not above 25 crores. That you have to correct. And 2 crores to 50 crores. Basing on internal rating. Our CRM is there basing on internal rating. So that you have to correct 50 crores only, you have to correct. So external credit rating above 50 crores now it is compulsory. And domestic credit rating agencies are old one only, no change. CARE, CRISIL, Fitch, ICRA, Acute and Infomerics. And the current year change is Brickworks rating. Last year, RBI has given circular that up to 250 crores only you take rating from Brickworks ratings. But now 250 crores ceiling is removed. For any amount, you can take rating from Brickworks. This is our domestic credit rating agency. Similarly, international credit rating agencies. Earlier, three rating agencies were there: Fitch, Moody's, Standard and Poor. Three international rating agencies. Current year, fourth one is added by Reserve Bank of India. That is Care Edge Global IFSC Limited. Care Edge Global IFSC. IFSC means International Financial Services Center. In India, only one International Financial Services Center is there. It is in Gift City, Gujarat, Ahmedabad. Gift City, Ahmedabad. We are having one International Finance Center. It is treated as actually on par with foreign bank, foreign branch. So any NRI customer who wants to avail facilities from that IFSC, our IFSC center branch, for them Care Edge Global IFSC Limited. This rating agency can give ratings. So fourth rating agency, International Credit Rating Agency, added current year. This is important for current year exam, right? Next, in respect of all external credit assessment institutions, rated accounts, credit rating press release. This is another one. Whenever we are going for external credit rating, that credit rating agency, what they have to do after completion of rating, whatever rating it has come, it has to give press release. In press release, they have to mention this bank has given them this money limits. So they have to mention bank name and also mention exposure limits also. If they don't mention bank name and limits, then we will not consider as rating. It is not eligible for credit rating. This is what Reserve Bank guideline. So they have to mention compulsorily bank name and also exposure limit in press release. Okay, this is another guideline. Last year it has come. It is treated as unrated and attracts 100% or 150%. And obtention of external rating in case of greenfield projects. Greenfield projects means starting from scratch. Starting from scratch, now project started. That is greenfield. Brownfield means expansion. That is the difference. Okay. In case of greenfield projects, within 6 months from the date of disbursement, they have to obtain external rating. If party has already applied for external rating, then 3 months from date of sanction, they have to submit. Next, in case of externally unrated borrowers with exposure above 50 crores, additional interest at the rate of 0.5% on fund-based facilities and 0.1% on non-fund-based facilities will be charged over and above the applicable rate of interest. This point is also current year change and important for current year exam. Earlier, it was norm that above 25 crores norm, and if they are not getting rating, then 1% additional interest was there. Now it is changed. Above 50 crores, first change. Second one, additional interest 0.5% on fund-based facilities and 0.1% on non-fund-based facilities. We will charge additionally. These two important for current year exam and current year change, right? Next, monitoring of cross default. Here, cross default means default with one lender that may trigger default with another lender. In one bank, it is becoming NPA. That means in another bank, same borrower may default. This is what cross default. If it is not cured within 30 days, that means within 30 days, if it is not regularized, then we call it as cross default. Yeah. Yes, friends. Now we are closing because another session is also there, and remaining all whatever material I have given, and in future also I will be whatever material I am preparing, I am sharing through Mr. Ravi or Ms. Ananta sir. You will be getting that material. So any doubts or clarifications also, you are most welcome, or you may ask me. I will give you my mobile number also. Since I am in abroad, you may, yeah, since I am in abroad, you may send me through WhatsApp. It is here. WhatsApp message I will give you. WhatsApp. Oh, it is not there. No? Yeah. 9502. You may note down 9502 88 7598. 9502887598. This is my WhatsApp number. You may send me any query, clarification. I will reply. So, thank you, friends. With this, we will conclude today's session. Thank you.
Sir,
Yeah, Anand sir.
yeah, thank you, sir.
Yeah, a little, little bit delay hoga.
Yeah,
No
very
issue.
good class.
I will send it to you.
Marathon session.
Yes,
Sir,
sir, yes.
that PowerPoint and PDF I have not got.
Immediately, I am sending immediately, sir.
So that I will share today.
Yeah, immediately I am sending, sir.
Many people were asking about PPT. We are sharing specifically after the class because becomes mostly with materials. People are skipping the classes.
Yes, and sir, apart from that, I want to tell one thing. RBI, I have sent this one, sir. RBI notification. So after sending, I have added 2, 3 points because recently it has come. That
Okay.
also I will share you now, sir. Latest one I will share you.
Okay, sir.
Please circulate to that also, sir, for all people. Because RBI notifications, whatever received during 2025, very, very important for current exam. Certainly they will take for any exam all 3, 4 exams, certainly it will be taken. So that also I will share now, sir.
Yes, sir.
PPTs, PDF,
If
and also
possible,
RBI
we will
guidance.
have another 1 or 2 hour session later also, sir, if it is
Yeah,
possible
sure,
for you.
sure, sir, sure, sure.
For
Sure,
RBI latest updates alone, if you can share.
yes, yeah, sure, sir. Sure. Okay.
Thank you
So
very
thank you, sir. Thank
much.
you, sir.
Please go
Thank
to
you,
sleep
friends.
now.
Thank you. Yeah, I will send. I will send. Yeah. Leave me.
Thank you, friends. Afternoon session, we will start at 2:30, not at 2 o'clock, as shared in the earlier in the WhatsApp group messages. Because Mr. Ravi Kumar is ready with some new type of taking class. In addition to his regular style of PowerPoint and other things, he is planning to do some quiz also. So we will join at 2:30, sir. So I request all of you to exit now and join us at 2:30 with the new link. Thank you.